Distinguishing between assets and liabilities. The second fundamental principle is understanding the difference between assets and liabilities. An asset is something that puts money in your pocket over time. A liability is something that takes money out of your pocket over time. This distinction, popularized by Robert Kiyosaki, is crucial for building wealth. Many people think they are buying assets when they are actually buying liabilities. For example, a house that you live in is often considered an asset, but if you look at the cash flow, it might actually be a liability. You pay mortgage payments, property taxes, insurance, maintenance, and utilities. Unless the house is generating rental income that exceeds all these costs, it is taking money out of your pocket each month, making it a liability from a cash flow perspective. True assets include things like rental properties that generate positive cash flow, dividend-paying stocks, bonds, royalties from intellectual property, and businesses that generate income without requiring your constant presence. The key to building wealth is to acquire as many true assets as possible while minimizing liabilities.
Understanding and using leverage strategically. The third principle involves understanding leverage. Leverage allows you to control large amounts of assets with relatively small amounts of your own money. This can dramatically accelerate wealth building, but it also increases risk. There are several types of leverage that wealthy individuals use strategically. Financial leverage involves borrowing money to invest in assets. For example, when you buy real estate with a mortgage, you are using the bank's money to control a valuable asset. If the property appreciates in value, you benefit from the appreciation of the entire property value, not just your down payment. This can lead to returns that exceed what you could achieve with just your own money. However, leverage is a double-edged sword. Just as it can amplify gains, it can also amplify losses. If property values decline, you could lose more than your initial investment. This is why understanding risk management is crucial when using leverage. Other forms of leverage include using other people's time and expertise. When you hire employees or contractors, you are leveraging their time and skills to create value that exceeds what you pay them. When you invest in managed funds, you are leveraging the expertise of professional investors. When you buy stocks, you are leveraging the efforts of thousands of employees. Creating multiple income streams. The fourth principle is creating multiple income streams. Relying on a single source of income, even a high-paying job, leaves you vulnerable to economic changes beyond your control. Wealthy individuals typically have income flowing from many different sources. This might include salary from employment, profits from businesses, rental income from real estate, dividends from stocks, interest from bonds, royalties from creative work, and capital gains from investments. Each income stream reduces your overall risk because it is unlikely that all streams would disappear simultaneously. Additionally, multiple income streams can be synergistic. The skills you develop in one area can often be applied to create income in other areas. The contacts you make in one business can lead to opportunities in completely different fields. Building multiple income streams takes time and often requires starting small. You might begin by developing a side business while maintaining your regular job. As the side business grows and becomes more reliable, you can gradually shift more time and energy toward it. Eventually, you might have several businesses or investments generating income, providing both security and growth potential. Investing in yourself and personal development. The fifth principle involves understanding the power of investing in yourself. The most reliable asset you can invest in is your own knowledge, skills, and capabilities. Unlike external investments, investments in yourself cannot be taken away by market crashes, economic recessions, or company bankruptcies. Investing in yourself might involve formal education, but it can also include reading books, attending seminars, taking online courses, learning new skills, or gaining experience in different industries. Every skill you develop and every piece of knowledge you acquire increases your ability to create value for others, which is ultimately the source of all wealth. Some of the highest return investments you can make are in developing high-value skills. These might include sales skills, which are valuable in almost every industry and situation. Marketing skills help you communicate value effectively, whether you are selling products, services, or ideas. Financial literacy helps you make better decisions with money and identify opportunities that others miss. Technology skills are increasingly valuable as the world becomes more digital. Communication skills are universally valuable because virtually every human endeavor involves working with other people. Leadership skills allow you to organize and motivate others to achieve goals that would be impossible to accomplish alone. Problem-solving skills help you identify opportunities where you can create value by solving problems that others cannot or will not solve. Understanding market dynamics and timing. The sixth principle is understanding market dynamics and timing. While timing the market perfectly is impossible, understanding general market cycles and economic trends can help you make better decisions about when to buy, sell, hold, or wait. Markets tend to move in cycles. There are periods of growth, followed by periods of decline, followed by recovery and growth again. These cycles occur in stock markets, real estate markets, commodity markets, and even in entire economies. Understanding these cycles does not mean you can predict them perfectly, but it can help you avoid making emotional decisions at the worst possible times. For example, during market downturns, many people panic and sell their investments at low prices. However, market downturns often present the best opportunities to buy high-quality assets at discounted prices. Those who understand this principle and have the patience and cash flow to invest during downturns often achieve superior long-term returns. Similarly, during market peaks, it can be tempting to invest heavily because everything seems to be going up. However, this is often when assets are overvalued and future returns are likely to be lower. Understanding market cycles helps you maintain perspective and make more rational decisions. Understanding taxes and legal structures. The seventh principle involves understanding taxes and legal structures. Taxes are often one of the largest expenses that wealthy individuals face, but there are many legal strategies to minimize tax burden and maximize after-tax wealth. Different types of income are taxed differently. Ordinary income from wages and salaries is typically taxed at the highest rates. Capital gains from investments held for longer than 1 year are often taxed at lower rates. Income from certain types of real estate investments can be offset by depreciation deductions. Income from municipal bonds is often tax-free at the federal level and sometimes at the state level as well. Wealthy individuals often structure their affairs to maximize income that is taxed at lower rates and minimize income that is taxed at higher rates. This might involve holding investments for longer periods to qualify for long-term capital gains treatment, investing in tax-advantaged retirement accounts, or structuring business activities as corporations or partnerships rather than sole proprietorships. Understanding legal structures is also important for asset protection. Properly structured entities can protect personal assets from business liabilities and provide tax advantages. However, these strategies can be complex and often require professional advice from accountants, attorneys, and financial planners who specialize in working with high net worth individuals. Building networks and relationships. The eighth principle is understanding the importance of networks and relationships. Many of the best investment opportunities, business deals, and career advancement opportunities come through personal networks rather than public markets or job postings. Building a strong network takes time and requires a genuine interest in helping others succeed. The most valuable relationships are those where you provide value to others before asking for anything in return. This might involve sharing useful information, making introductions between people who can help each other, or offering your skills and expertise to help others achieve their goals. Wealthy individuals often invest significant time and energy in building and maintaining relationships with other successful people. They attend industry conferences, join professional organizations, participate in charitable activities, and make an effort to stay in touch with colleagues, classmates, and business associates throughout their careers. These relationships can lead to investment opportunities that are not available to the general public. They can provide access to mentorship and advice from people who have already achieved success in areas where you are trying to build wealth. They can also lead to business partnerships that allow you to achieve goals that would be impossible to accomplish alone. Understanding different asset classes and investment strategies. The ninth principle involves understanding different asset classes and investment strategies. Diversification across different types of assets can reduce risk while maintaining growth potential. Each asset class has different risk and return characteristics, and they often perform differently under various economic conditions. Stocks represent ownership shares in companies and historically have provided higher long-term returns than most other asset classes, but they also tend to be more volatile in the short term. Bonds represent loans to companies or governments and typically provide more stable income with lower growth potential. Real estate can provide both current income through rents and long-term appreciation, but it requires more active management than stocks or bonds. Commodities like gold, oil, and agricultural products can provide protection against inflation and currency devaluation, but they typically do not provide current income and can be volatile. Alternative investments like private equity, hedge funds, and venture capital can provide access to investment strategies that are not available through public markets, but they often require large minimum investments and have limited liquidity. Within each asset class, there are many different strategies and approaches. For stocks, you might focus on growth companies that are expected to increase their earnings rapidly, value companies that appear to be trading below their intrinsic worth, or dividend-paying companies that provide current income. You might invest in domestic companies, international companies, or companies in specific industries or sectors. For real estate, you might focus on residential properties, commercial properties, industrial properties, or real estate investment trusts that allow you to invest in real estate without directly owning and managing properties. You might focus on properties in your local area where you have more knowledge and control, or you might invest in properties in different geographic areas to diversify your exposure. The key is to understand the characteristics of different asset classes and investment strategies so you can build a portfolio that matches your risk tolerance, time horizon, and financial goals. This typically involves spreading investments across multiple asset classes and strategies rather than concentrating everything in a single type of investment. Understanding the psychology of wealth building. The 10th principle is understanding the psychology of wealth building. Building wealth requires making decisions that often go against natural human instincts. Our brains are wired for immediate gratification, but building wealth requires delaying gratification and making short-term sacrifices for long-term benefits. Successful wealth building requires developing discipline and the ability to stick with strategies even when they are not immediately rewarding. This might mean living below your means so you can invest the difference, continuing to invest during market downturns when it feels scary, or working long hours to build a business while others are enjoying leisure time. It also requires managing emotions like fear and greed that can lead to poor financial decisions. Fear can cause you to avoid taking reasonable risks that are necessary for wealth building, or to sell investments at low prices during market downturns. Greed can cause you to take excessive risks or to buy investments at high prices during market peaks. Understanding these psychological tendencies and developing strategies to manage them is crucial for long-term success. This might involve automating investments so you do not have to make emotional decisions each month, setting up systems that prevent you from making impulsive decisions, or working with advisors who can provide objective perspectives when your emotions might cloud your judgment. Many wealthy individuals also cultivate habits and mindsets that support wealth building. They tend to be lifelong learners who constantly seek new knowledge and skills. They tend to be optimistic about the future while also being realistic about risks and challenges. They tend to focus on what they can control rather than worrying about what they cannot control. They also tend to think in terms of abundance rather than scarcity. Instead of thinking that there is a fixed amount of wealth in the world and that one person's gain must come at another person's expense, they understand that wealth can be created when people provide value to others. This mindset leads to seeking win-win opportunities rather than zero-sum competitions. Understanding entrepreneurship and business creation. The 11th principle involves understanding entrepreneurship and business creation. Starting and growing businesses is one of the most reliable paths to significant wealth creation. While not everyone is suited to be an entrepreneur, Understanding business principles can help you identify opportunities and make better investment decisions, even if you choose to be an employee or passive investor. Successful businesses solve problems for customers in ways that create more value than they consume. They find ways to provide products or services that customers want at prices they are willing to pay, while managing costs effectively enough to generate profits. The most successful businesses often solve important problems for large numbers of people, or solve moderately important problems for people who are willing to pay premium prices. Scalability is a key factor in business success and wealth creation. Scalable businesses can grow their revenue without proportionally increasing their costs. Software businesses are highly scalable because once the software is created, it can be sold to unlimited numbers of customers without significant additional costs. Service businesses that rely on personal time and attention are less scalable because there are only so many hours in a day. Many successful businesses start small and grow gradually. This allows entrepreneurs to learn and refine their approaches while managing risks. Starting with limited resources forces creativity and efficiency that can become competitive advantages as the business grows. Even if you do not start your own business, understanding business principles can help you be more valuable as an employee and make better investment decisions. Companies that have sustainable competitive advantages, strong management teams, and growing markets tend to be better long-term investments than companies that lack these characteristics. Understanding technology and digital opportunities. The 12th principle is understanding technology and digital opportunities. Technology has created new ways to build wealth that did not exist in previous generations. The internet allows individuals to reach global markets with relatively low startup costs. Digital products and services can be scaled much more easily than physical products. E-commerce allows people to start retail businesses without the overhead costs of physical stores. Digital marketing allows businesses to target potential customers much more precisely than traditional advertising methods. Online education allows people to monetize their knowledge and expertise by teaching others around the world. Cryptocurrency and blockchain technologies have created new asset classes and investment opportunities, though they also involve significant risks and regulatory uncertainties. These technologies are still evolving rapidly, and their long-term impact on wealth creation is still unknown. Automation and artificial intelligence are changing many industries and creating both opportunities and challenges. Jobs that involve routine tasks are increasingly being automated, while jobs that require creativity, critical thinking, and human interaction are becoming more valuable. Understanding these trends can help you develop skills and make investments that benefit from technological change rather than being displaced by it. Social media and digital platforms have created new ways for individuals to build audiences and monetize their expertise, creativity, or entertainment value. Content creators can earn income through advertising, sponsorships, product sales, and direct payments from fans. However, these opportunities also involve risks related to platform changes, algorithm updates, and market saturation. Understanding global economic trends and opportunities. The 13th principle involves understanding global economic trends and opportunities. Wealth creation increasingly involves understanding and participating in global markets rather than just local or national markets. Different countries and regions have different growth rates, interest rates, currency values, and regulatory environments that create various opportunities and risks. Emerging markets often have higher growth rates than developed markets, but they also tend to have higher volatility and different types of risks. Developed markets tend to be more stable and have better regulatory protections, but they often have lower growth rates and higher valuations. Currency exchange rates affect the value of international investments and can create opportunities for those who understand global economic dynamics. International diversification can reduce risk by spreading investments across different economic and political systems. Global demographic trends affect investment opportunities. Countries with young, growing populations often have higher economic growth rates, while countries with aging populations may have different investment characteristics. Understanding these trends can help guide long-term investment decisions. Trade relationships, technological adoption rates, natural resource availability, and government policies all affect economic conditions in different countries and regions. Staying informed about global trends can help identify emerging opportunities and potential risks. Understanding risk management and insurance. The 14th principle is understanding risk management and insurance. Building wealth requires taking calculated risks, but it also requires protecting against catastrophic losses that could destroy accumulated wealth. Insurance is one of the primary tools for managing risk. Health insurance protects against medical expenses that could bankrupt families. Disability insurance protects against loss of income due to illness or injury. Life insurance can protect families against the financial impact of premature death. Property insurance protects against losses from theft, damage, or natural disasters. Liability insurance protects against lawsuits and claims from others. Professional liability insurance protects against claims related to professional services. Umbrella insurance provides additional protection beyond the limits of other insurance policies. While insurance involves costs that reduce current income, it protects against losses that could be much larger than the insurance premiums. The key is finding the right balance between protection and cost, which often involves choosing higher deductibles to reduce premiums while maintaining coverage for truly catastrophic losses. Beyond insurance, risk management also involves diversification, maintaining emergency funds, avoiding excessive leverage, and making conservative assumptions when planning for the future. It involves understanding that higher potential returns typically come with higher risks and structuring investments appropriately based on your ability to tolerate losses. Understanding estate planning and wealth transfer. The 15th principle involves understanding estate planning and wealth transfer. Once you have built significant wealth, planning for its transfer to future generations or charitable causes becomes important both for tax efficiency and for ensuring that your wealth continues to have positive impact after you are no longer able to manage it directly. Estate planning involves creating wills, trusts, and other legal documents that specify how your assets should be distributed after your death. It also involves strategies to minimize estate taxes and other transfer costs that could reduce the amount available to your beneficiaries. Trusts can be particularly useful tools for wealth transfer because they can provide ongoing management of assets, protect beneficiaries from their own financial mistakes, and provide tax advantages. Different types of trusts have different characteristics and are suitable for different situations. Charitable giving can also be an important component of estate planning, both for the personal satisfaction of supporting causes you care about and for the tax advantages that charitable contributions can provide. There are many strategies for charitable giving that can provide current tax deductions, reduce estate taxes, and still provide income for you or your family. Teaching financial literacy to children and other family members is also an important part of wealth transfer. Wealth that is inherited by people who do not understand how to manage it effectively is often lost within a generation or two. Providing education along with financial inheritance increases the likelihood that wealth will continue to grow and benefit future generations. Understanding the importance of health and relationships. The 16th principle involves understanding the importance of health and relationships in wealth building. True wealth includes not just financial assets, but also physical health, mental well-being, and strong relationships with family and friends. These non-financial assets can be more important than money for overall life satisfaction and can also support financial success. Good physical health reduces medical expenses and allows you to work productively for more years. It also provides energy and mental clarity that can improve decision-making and performance in all areas of life. Investing in health through proper nutrition, regular exercise, adequate sleep, and preventive medical care often provides excellent returns through reduced healthcare costs and improved quality of life. Mental and emotional health are also important for wealth building because they affect your ability to make good decisions, maintain discipline, and recover from setbacks. Chronic stress, anxiety, and depression can impair judgment and lead to poor financial decisions. investing in mental health through stress management techniques, therapy when needed, and maintaining work-life balance can support both financial success and overall well-being. Strong relationships provide emotional support during difficult times and can also provide practical assistance, business opportunities, and career advancement. People with strong social networks tend to be happier, healthier, and more successful in their careers and businesses. Investing time and energy in building and maintaining relationships can provide both personal satisfaction and financial benefits. Understanding the role of giving and philanthropy. The 17th principle is understanding the role of giving and philanthropy in wealth building. While it might seem counterintuitive, giving money away can actually support wealth building in several ways. Charitable giving can provide tax deductions that reduce your overall tax burden. It can also help build relationships with other philanthropically minded individuals who may become business partners, clients, or sources of investment opportunities. More importantly, developing a mindset of abundance and contribution can create opportunities that would not otherwise exist. People are more likely to want to work with, invest with, and support individuals who are known for their generosity and commitment to making positive impacts in their communities. Philanthropic activities can also provide learning opportunities and exposure to new ideas, people, and situations that can lead to business insights and opportunities. Serving on non-profit boards or participating in charitable events can develop leadership skills, expand networks, and provide experience with different types of organizations and challenges. Even when financial resources are limited, contributing time, skills, or expertise to causes you care about can provide many of the same benefits as monetary contributions. Volunteering can develop new skills, create relationships, and provide experiences that enhance your ability to create value in other areas of your life. Understanding continuous learning and adaptation. The 18th principle involves understanding the importance of continuous learning and adaptation. The economic environment, technology, regulations, and market conditions are constantly changing. Strategies that work well in one period may become less effective or even counterproductive in different circumstances. Successful wealth builders tend to be lifelong learners who continuously update their knowledge and adapt their strategies based on new information and changing conditions. They read extensively, attend educational events, seek advice from experts, and learn from both their successes and failures. They also tend to be experimental in their approach, trying new strategies on a small scale before committing large amounts of resources. This allows them to learn and refine their approaches while managing risks. They understand that some experiments will fail, but they view failures as learning opportunities rather than reasons to stop trying new approaches. Staying curious and open-minded is important because many of the best opportunities come from unexpected sources or involve combining ideas from different fields in new ways. People who are rigid in their thinking or too attached to past strategies may miss opportunities or fail to adapt to changing conditions. Understanding the power of systems and automation. The 19th principle is understanding the power of systems and automation. Building wealth requires making many good decisions consistently over long periods of time. Creating systems and automating processes can help ensure that good decisions are made regularly without requiring constant attention and willpower. For example, automatic investment plans ensure that money is invested regularly regardless of market conditions or emotional states. Automatic bill payment systems ensure that bills are paid on time and avoid late fees. Budgeting and expense tracking systems help monitor spending and identify areas for improvement. Business systems help ensure that important tasks are completed consistently and efficiently, even as businesses grow and become more complex. Investment systems help ensure that portfolios are rebalanced regularly and that investment decisions are based on predetermined criteria rather than emotional reactions to market movements. Creating systems often requires upfront time and effort, but they can save much more time and effort over the long term, while also improving results. Systems also make it easier to delegate tasks to others and scale operations beyond what one person can manage personally. Understanding patience and long-term thinking. The 20th principle involves understanding the importance of patience and long-term thinking. Building significant wealth typically takes many years or even decades. Most overnight success stories actually involve years of preparation and gradual progress before achieving visible results. Compound interest, business growth, skill development, and relationship building all require time to reach their full potential. People who focus only on short-term results often make decisions that harm their long-term prospects. For example, spending investment returns rather than reinvesting them prevents compound growth from reaching its full potential. Long-term thinking also helps avoid making emotional decisions during temporary setbacks. Market downturns, business challenges, and economic recessions are normal parts of long-term wealth-building cycles. People who maintain long-term perspectives are better able to stay focused on their goals and continue implementing their strategies during difficult periods. Having clear long-term goals and regularly reviewing progress toward those goals can help maintain motivation and make better decisions about how to allocate time, energy, and resources. Writing down goals and reviewing them regularly has been shown to increase the likelihood of achieving them. Understanding real estate investment approaches. The 21st principle is understanding different approaches to real estate investment. Real estate has been a reliable wealth-building tool for many people because it can provide both current income through rents and long-term appreciation. It also provides diversification from stock market investments and can serve as a hedge against inflation. Direct real estate investment involves purchasing properties and managing them yourself. This can provide the highest returns, but also requires the most time, expertise, and risk management. Successful direct real estate investors understand local markets, property values, rental rates, maintenance costs, and legal requirements. Real estate investment trusts allow you to invest in real estate without directly owning and managing properties. REITs are companies that own and operate income-producing real estate and are required to distribute most of their income to shareholders as dividends. This provides exposure to real estate markets with professional management and liquidity that direct ownership does not provide. Real estate partnerships and syndications allow investors to pool resources to purchase properties that would be too expensive for individual investors. These arrangements can provide access to larger, higher quality properties and professional management, while allowing investors to participate with smaller amounts of capital. Different types of properties have different characteristics and potential returns. Residential properties tend to be easier to understand and manage, but may have lower returns than commercial properties. Commercial properties often have higher returns, but require more expertise and larger investments. Industrial properties, office buildings, retail spaces, and specialized properties like storage facilities or medical buildings all have different market dynamics and investment characteristics. Location is crucial in real estate investment because it affects rental rates, appreciation potential, and liquidity. Properties in growing areas with good schools, employment opportunities, and infrastructure tend to perform better than properties in declining areas. Understanding demographic trends, economic development plans, and local market conditions is important for making good real estate investment decisions. Understanding stock market investing strategies. The 22nd principle involves understanding stock market investing strategies. The stock market has historically provided higher long-term returns than most other asset classes, but it requires understanding different approaches and managing volatility. Value investing involves buying stocks that appear to be trading below their intrinsic value based on financial analysis. This approach, popularized by Benjamin Graham and Warren Buffett, focuses on companies with strong fundamentals that may be temporarily out of favor with investors. Growth investing focuses on companies that are expected to grow their earnings faster than average. These stocks often trade at higher valuations, but can provide superior returns if the companies achieve their growth potential. Dividend investing focuses on companies that pay regular dividends to shareholders. This approach can provide current income and may be less volatile than growth stocks, but dividend payments are not guaranteed and can be reduced or eliminated during difficult periods. Index investing involves buying funds that track market indexes like the S&P 500. This provides broad diversification and typically has lower costs than actively managed funds. Research has shown that most actively managed funds do not outperform index funds over long periods after accounting for fees and taxes. Dollar-cost averaging involves investing fixed amounts at regular intervals regardless of market prices. This strategy reduces the impact of market timing and can result in buying more shares when prices are low and fewer shares when prices are high. Sector rotation involves shifting investments between different industry sectors based on economic cycles and market conditions. This strategy requires more active management but can potentially improve returns by focusing on sectors that are expected to outperform during specific economic conditions. Understanding alternative investments. The 23rd principle is understanding alternative investments and their role in diversified portfolios. Alternative investments include asset classes and strategies that are different from traditional stocks, bonds, and real estate. Private equity involves investing in companies that are not publicly traded. This can include venture capital investments in startup companies, buyout investments in established companies, and growth capital for expanding businesses. Private equity investments often require large minimum investments, have limited liquidity, and involve higher risks, but they can also provide higher returns than public market investments. Hedge funds use various strategies to try to generate returns that are not correlated with traditional market movements. These might include long-short equity strategies, merger arbitrage, distressed debt investing, or global macro strategies. Hedge funds typically have high fees and minimum investment requirements, and their performance can vary widely. Commodity investments provide exposure to raw materials like gold, oil, agricultural products, and industrial metals. Commodities can provide diversification and inflation protection, but they typically do not provide current income and can be volatile. Collectibles like art, antiques, rare coins, or vintage cars can appreciate in value over time, but they require specialized knowledge, have high transaction costs, and may be difficult to sell quickly. They should typically represent only a small portion of investment portfolios. Cryptocurrency represents a new and rapidly evolving asset class that has attracted significant attention and investment. However, cryptocurrencies are highly volatile, face regulatory uncertainties, and have limited track records compared to traditional asset classes. The key with alternative investments is understanding their risk and return characteristics, how they might complement traditional investments, and ensuring that they represent appropriate portions of overall portfolios based on individual circumstances and risk tolerance. Understanding international investing and global diversification. The 24th principle involves understanding international investing and global diversification. Investing only in domestic markets can limit growth opportunities and increase concentration risk. International diversification can provide access to growing economies, different industries, and currency diversification. Developed international markets include countries like those in Europe, Japan, and Australia that have mature economies and well-established financial markets. These markets often provide stability and diversification benefits, though they may have lower growth rates than emerging markets. Emerging markets include countries like China, India, Brazil, and many others that are experiencing rapid economic growth, but may also have higher volatility and different types of risks. These markets can provide higher growth potential, but require understanding political risks, currency risks, and different regulatory environments. Currency exposure is an important consideration in international investing because changes in exchange rates can affect investment returns. Some international investments are currency hedged to reduce this risk, while others provide full currency exposure that can enhance or reduce returns. International investing can be accomplished through individual foreign stocks, international mutual funds or ETFs, global funds that invest in both domestic and international markets, or regional funds that focus on specific geographic areas. Understanding the correlation between different markets is important for effective diversification. Markets that tend to move together do not provide as much diversification benefit as markets that move independently or in opposite directions. Understanding professional advisors and when to seek help. The 25th principle is understanding the role of professional advisors and when to seek help. Building wealth can be complex, and professional advisors can provide expertise, objectivity, and services that are difficult to replicate individually. Financial planners can help develop comprehensive financial plans that coordinate investments, insurance, tax planning, and estate planning. They can provide objective advice and help maintain discipline during emotional market periods. Different types of financial planners have different qualifications, compensation structures, and areas of expertise. Investment advisors can help with portfolio management, asset allocation, and investment selection. They may provide more sophisticated strategies and access to investments that are not readily available to individual investors. Understanding how advisors are compensated is important because it can affect the advice they provide. Tax professionals can help with tax planning and preparation, especially as wealth and complexity increase. They can identify strategies to minimize tax burdens and ensure compliance with tax laws that become more complex at higher wealth levels. Estate planning attorneys can help with wills, trusts, and other legal documents that become more important as wealth accumulates. They can help structure affairs to minimize estate taxes and ensure that wealth is transferred according to your wishes. Insurance professionals can help identify appropriate coverage and structures to protect against various risks. They can also help with more sophisticated insurance strategies that can be useful for high net worth individuals. The key is understanding what types of advice and services you need, finding qualified professionals with appropriate experience and credentials, understanding how they are compensated, and maintaining ultimate responsibility for your financial decisions while leveraging their expertise effectively. Understanding the psychology of money and limiting beliefs. The 26th principle involves understanding the psychology of money and how your beliefs about money affect your ability to build wealth. Many people have unconscious beliefs about money that were formed during childhood and can either support or sabotage their wealth-building efforts. Some people believe that money is the root of all evil, or that wealthy people must have obtained their money through dishonest means. These beliefs can create internal conflicts that prevent people from taking the actions necessary to build wealth. If you believe that having money makes you a bad person, you will unconsciously sabotage your efforts to accumulate money. Other people believe that they do not deserve to be wealthy or that wealth is only for other types of people. These limiting beliefs can prevent people from pursuing opportunities or cause them to give up too easily when they encounter obstacles. Examining and changing limiting beliefs about money is often necessary for successful wealth building. This might involve recognizing that money is simply a tool that can be used for good or bad purposes depending on the person using it. Wealthy people who use their resources to help others, create jobs, solve problems, and support charitable causes are using money in positive ways. It might also involve recognizing that everyone has the potential to build wealth if they are willing to learn the necessary skills and apply them consistently over time. Wealth building is not limited to people with special talents or advantages, though some people may have head starts due to their circumstances. Developing a healthy relationship with money involves viewing it as a tool for creating security and opportunities rather than as a measure of personal worth or success. People who are too focused on money often make poor decisions because they are motivated by fear or greed rather than rational analysis. People who ignore money entirely often miss opportunities and fail to provide adequately for themselves and their families. Understanding financial education for family members. The 27th principle is understanding the importance of financial education for children and family members. One of the best investments you can make is teaching financial literacy to your children and other family members. This education can help them avoid common financial mistakes and give them the knowledge and skills needed to build their own wealth. Financial education for children can start at very young ages with simple concepts like saving, spending, and sharing. As children get older, they can learn about budgeting, compound interest, investing, and entrepreneurship. Real-world experience through allowances, part-time jobs, and involvement in family financial discussions can reinforce these concepts. Many schools do not provide adequate financial education, so parents and family members often need to take responsibility for ensuring that children learn these important life skills. There are many books, games, online resources, and programs designed to make financial education engaging and age-appropriate for children. Teaching children about money involves more than just technical knowledge. It also involves helping them develop good habits and attitudes about money. This includes the importance of hard work, delayed gratification, careful decision-making, and using money to help others. Children learn more from what they observe than from what they are told, so modeling good financial behavior is crucial. Children who grow up in households where adults save regularly, invest for the future, avoid unnecessary debt, and make thoughtful spending decisions are more likely to develop similar habits themselves. Understanding retirement planning strategies. The 28th principle involves understanding different retirement planning strategies and the importance of starting early. Retirement planning is a crucial component of wealth building because it involves accumulating assets that will provide income when you are no longer able or willing to work. The earlier you start saving for retirement, the more time compound interest has to work in your favor. Someone who starts saving at age 25 needs to save much less each month to achieve the same retirement income as someone who starts saving at age 25, age 35, or 45. Employer-sponsored retirement plans like 401k plans often provide matching contributions that represent free money. Taking full advantage of employer matches should be a high priority for anyone who has access to these benefits. These plans also provide tax advantages that can significantly increase the amount of money available for retirement. Individual retirement accounts provide additional opportunities for tax-advantaged retirement savings. Traditional IRAs provide tax deductions for contributions and tax-deferred growth, while Roth IRAs provide tax-free growth and withdrawals in retirement. Understanding the differences between these options can help you choose the most appropriate strategies for your situation. Social Security provides a foundation of retirement income for most Americans, but it is typically not sufficient to maintain pre-retirement living standards. Understanding how Social Security benefits are calculated and when to claim benefits can help optimize this important source of retirement income. Healthcare costs tend to increase with age and can represent a significant expense in retirement. Planning for these costs through health savings accounts, long-term care insurance, or other strategies is an important component of comprehensive retirement planning. Understanding inflation's role in wealth building. The 29th principle is understanding the role of inflation in wealth building and how to protect against its effects. Inflation reduces the purchasing power of money over time, which means that money saved in low-yielding accounts or investments may actually lose value in real terms, even if the nominal amount increases. Historical inflation rates have varied significantly over time, but over long periods, inflation has averaged around 3% per year in the United States. This means that money needs to grow at least 3% per year just to maintain its purchasing power, and it needs to grow faster than that to increase purchasing power. Assets that tend to perform well during inflationary periods include real estate, commodities, stocks of companies that can raise their prices with inflation, and Treasury inflation-protected securities that are specifically designed to adjust for inflation. Fixed-rate debt can actually benefit borrowers during inflationary periods because they repay loans with money that has less purchasing power than the money they borrowed. This is one reason why moderate amounts of fixed-rate mortgage debt can be beneficial for wealth building. Understanding inflation is important for setting realistic expectations for investment returns and retirement planning. Investment returns should be evaluated in real terms after accounting for inflation rather than just in nominal terms. Understanding economic cycles and market patterns. The 30th principle involves understanding economic cycles and how they create both challenges and opportunities for wealth building. Economies tend to move through cycles of expansion, peak, contraction, and recovery. Understanding these cycles can help you make better decisions about when to take risks and when to be more conservative. During economic expansions, employment is high, businesses are growing, and investment returns tend to be positive. This can be a good time to take calculated risks, start businesses, or invest in growth assets. However, it is also important to remember that expansions do not last forever and to prepare for eventual downturns. During economic contractions or recessions, unemployment rises, businesses struggle, and investment returns may be negative. This can be a challenging time for wealth building, but it can also create opportunities for those who are prepared. Asset prices often decline during recessions, creating buying opportunities for investors with available cash. The key to navigating economic cycles is maintaining financial flexibility through diversified income streams, emergency funds, moderate debt levels, and diversified investment portfolios. This allows you to weather downturns while positioning yourself to take advantage of opportunities that arise. Historical perspective is important when evaluating current economic conditions. While each economic cycle has unique characteristics, there are patterns that tend to repeat over time. Understanding these patterns can help you maintain perspective during both good times and challenging times. Understanding goal setting and progress monitoring. The 31st principle is understanding the importance of continuous goal setting and progress monitoring. Building wealth is a long-term process that requires staying motivated and focused over many years. Setting specific, measurable goals and regularly monitoring progress toward those goals can help maintain motivation and ensure that you are staying on track. Financial goals should be specific and measurable rather than vague. Instead of saying you want to be rich, specify that you want to have a certain amount invested by a certain date or generate a specific amount of passive income. This makes it easier to create plans for achieving the goals and to measure progress along the way. Goals should also be realistic and achievable given your current situation and resources. Setting goals that are too aggressive can lead to discouragement when they are not achieved, while setting goals that are too easy may not provide sufficient motivation for taking the actions necessary to build wealth. Long-term goals should be broken down into smaller, shorter-term goals that are easier to achieve and monitor. For example, a goal to accumulate $1 million in 20 years might be broken down into annual goals for savings and investment returns, monthly goals for savings amounts, and weekly goals for specific actions like research or education. Regular review and adjustment of goals is important because circumstances change over time. What seemed realistic when you set a goal may need to be adjusted based on changes in income, expenses, market conditions, or personal priorities. This is a normal part of the planning process and should not be viewed as failure. Understanding the power of financial habits. The 32nd principle involves understanding the power of habits in wealth building. Building wealth requires making many small decisions consistently over long periods of time. Developing good financial habits can make these decisions automatic and reduce the mental energy required for wealth building. Savings habits are fundamental to wealth building. Automating savings so that money is transferred to investment accounts before you have a chance to spend it can make saving effortless. Gradually increasing savings amounts as income grows can accelerate wealth accumulation without requiring significant lifestyle changes. Spending habits also significantly impact wealth building. Developing habits that avoid unnecessary purchases, compare prices before making major purchases, and focus spending on things that provide genuine value can free up money for savings and investment. Learning habits support wealth building by ensuring that you continue to develop new knowledge and skills throughout your life. This might involve reading financial books or articles regularly, listening to educational podcasts, attending seminars, or taking courses to expand your expertise. Exercise and health habits support wealth building by maintaining the physical and mental energy needed for success. Good health reduces medical expenses and allows you to work productively for more years, while also improving your quality of life. Understanding progress, measurement, and tracking. The 33rd principle is understanding the importance of measuring and tracking your progress. What gets measured gets managed, and tracking your financial progress can help you identify what is working well and what needs improvement in your wealth-building efforts. Net worth tracking involves calculating your total assets minus your total liabilities on a regular basis. This provides a comprehensive picture of your overall financial progress and can help you see whether your wealth-building efforts are having the desired impact. Cash flow tracking involves monitoring income and expenses to ensure that you are living within your means and maximizing the amount available for savings and investment. This can help identify areas where expenses might be reduced or income might be increased. Investment performance tracking involves monitoring the returns on your various investments to ensure that they are meeting your expectations and that your overall portfolio allocation remains appropriate for your goals and risk tolerance. Goal progress tracking involves regularly reviewing your progress towards specific financial goals and adjusting your strategies or timelines as needed based on your actual results compared to your projections. Many tools and apps are available to help with financial tracking, or you can create your own systems using spreadsheets or other simple tools. The key is finding a system that you will use consistently rather than one that is so complex or time-consuming that you abandon it. Understanding strategic debt management. The 34th principle involves understanding different approaches to debt management and how debt can either help or hurt wealth-building efforts. Not all debt is bad, and understanding how to use debt strategically can accelerate wealth building when used appropriately. High-interest consumer debt, like credit card debt, typically hurts wealth building because the interest rates are often higher than the returns you can earn on investments. Paying off high-interest debt is often equivalent to earning a guaranteed return equal to the interest rate on the debt. Low-interest debt, secured by appreciating assets, can actually support wealth building. Mortgage debt allows you to control valuable real estate with a relatively small down payment, and if the property appreciates faster than the interest rate on the mortgage, you benefit from leverage. Investment debt or margin can be used to purchase additional investments, but this increases risk because you can lose more than your initial investment if the investments decline in value. This strategy should only be used by experienced investors who understand the risks and have the financial capacity to absorb potential losses. Business debt can be valuable for starting or expanding businesses that generate returns higher than the cost of the debt. However, business debt also increases risk and should be used carefully with thorough analysis of the business's ability to service the debt. The key with debt is understanding the cost of the debt compared to the potential returns from whatever you are using the debt to purchase, and ensuring that you have the cash flow capacity to service the debt even if things do not go as planned. Understanding tax efficiency in wealth building. The 35th principle is understanding the importance of tax efficiency in wealth building. Taxes can be one of the largest expenses that wealthy individuals face, so understanding legal strategies to minimize taxes can significantly improve wealth accumulation. Tax-deferred accounts like traditional retirement accounts allow you to deduct contributions from current income and defer taxes until you withdraw the money in retirement when you may be in a lower tax bracket. This can provide significant benefits if you expect to be in a lower tax bracket in retirement. Tax-free accounts like Roth retirement accounts require you to pay taxes on contributions but allow tax-free growth and withdrawals. This can provide significant benefits if you expect to be in a higher tax bracket in the future or if you want to leave tax-free assets to heirs. Tax-efficient investing involves strategies like holding investments for longer than 1 year to qualify for lower capital gains tax rates, locating tax-inefficient investments in tax-deferred accounts, and harvesting tax losses to offset gains. Business ownership can provide tax advantages through deductions for business expenses, depreciation on business assets, and potentially more favorable treatment of business income compared to employment income. Real estate investing can provide tax advantages through depreciation deductions, 1,031 exchanges that defer capital gains taxes, and potentially more favorable treatment of real estate income. Understanding income generation and passive income. The 36th principle involves understanding different approaches to income generation and how active income can be converted into passive income over time. Building wealth often involves transitioning from earning money primarily through active work to earning money through passive income sources that do not require ongoing time and effort. Employment income provides security and benefits, but is limited by the number of hours you can work and typically stops when you stop working. However, employment income can provide the cash flow needed to invest in passive income sources. Business ownership can provide higher income potential than employment, but typically requires more time and effort, especially in the early stages. However, businesses can eventually be structured to generate income without requiring the owner's constant involvement. Investment income from dividends, interest, rents, and capital gains can provide passive income that continues regardless of whether you are actively working. Building a portfolio of income-generating investments is often a key component of long-term wealth building. Royalty income from intellectual property like books, music, patents, or software can provide ongoing income from work that was completed in the past. Creating intellectual property that generates ongoing royalties can be a powerful wealth-building strategy for people with relevant skills and expertise. The goal for many wealth builders is to eventually have enough passive income to cover their living expenses, providing financial independence and the freedom to choose how to spend their time. Understanding risk tolerance and investment decisions. The 37th principle is understanding the importance of risk tolerance and how it affects investment decisions. Different people have different abilities and willingness to accept risk, and understanding your own risk tolerance is crucial for making appropriate investment decisions. Risk tolerance is affected by factors like age, income stability, family situation, investment experience, and personality. Younger people often can accept more risk because they have more time to recover from losses, while older people approaching retirement may need to be more conservative to protect accumulated wealth. People with stable, high incomes may be able to accept more risk in their investments because they have reliable cash flow to cover living expenses and continue investing even during market downturns. People with variable or uncertain incomes may need to be more conservative to ensure they have adequate liquidity. Risk tolerance can change over time as circumstances change. Someone who was comfortable with high-risk investments when they were young and had little to lose might become more conservative as they accumulate wealth and have more to protect. The key is finding the right balance between accepting enough risk to achieve your growth goals while avoiding so much risk that you are likely to panic and make poor decisions during market downturns. This often involves diversifying across different types of investments with different risk characteristics. Understanding the relationship between risk and return is also important. Higher potential returns typically come with higher risks, and investments that seem to offer high returns with low risk often have hidden risks that are not immediately apparent. Understanding business investment and entrepreneurship. The 38th principle involves understanding different approaches to business investing and entrepreneurship. Starting and investing in businesses can be one of the most effective ways to build wealth, but it also involves unique risks and challenges that require careful consideration. Starting your own business allows you to potentially create unlimited value, but also involves the risk of losing your initial investment and the time and effort you put into the business. Success often requires skills in multiple areas, including the core business function, marketing, finance, and management. Buying existing businesses can reduce some of the risks of starting from scratch because you can evaluate the business's historical performance and existing customer base. However, existing businesses may also have hidden problems or may be priced to reflect their past success rather than their future potential. Investing in other people's businesses through private equity, venture capital, or angel investing allows you to diversify across multiple businesses and leverage other people's expertise. However, these investments often require large minimum investments, have limited liquidity, and involve high risks. Franchising allows you to start a business using a proven business model and receive ongoing support from the franchisor. This can reduce some of the risks of starting an independent business, but also involves ongoing fees and restrictions on how you operate the business. The key to successful business investing is understanding the factors that drive business success, including market demand, competitive advantages, management quality, financial controls, and scalability potential. Understanding insurance's role in asset protection. The 39th principle is understanding the role of insurance in wealth building and asset protection. Insurance serves two primary purposes in wealth building. protecting against catastrophic losses that could destroy accumulated wealth and providing tax-advantaged investment vehicles. Life insurance protects against the financial impact of premature death and can be particularly important for people who have dependents or significant debt. Term life insurance provides pure insurance coverage at relatively low cost, while permanent life insurance combines insurance coverage with investment features. Disability insurance protects against loss of income due to illness or injury and can be more important than life insurance for younger people because the probability of becoming disabled is often higher than the probability of dying prematurely. Property and casualty insurance protects against losses from theft, accidents, natural disasters, and liability claims. Umbrella insurance provides additional liability protection beyond the limits of homeowners and auto insurance policies. Professional liability insurance protects against claims related to professional services and can be important for people in certain occupations like medicine, law, accounting, or consulting. Some types of permanent life insurance can provide tax-advantaged investment growth and access to cash values through loans or withdrawals. These strategies can be complex and should be evaluated carefully with professional guidance. Understanding advanced estate planning strategies. The 40th principle involves understanding the importance of estate planning and wealth transfer strategies. Once you have accumulated significant wealth, planning for its transfer to future generations or charitable causes becomes important for both tax efficiency and ensuring that your wealth continues to have positive impact. Wills specify how assets should be distributed after death, but must go through probate court proceedings that can be time-consuming and expensive. Trusts can provide more control over asset distribution, avoid probate, and provide tax advantages. Different types of trusts have different characteristics and tax implications. Revocable trusts provide flexibility but limited tax benefits, while irrevocable trusts can provide significant tax benefits but reduce your control over the assets. Gifting strategies can reduce estate taxes by transferring wealth to heirs during your lifetime. Annual gift tax exclusions allow you to give limited amounts to multiple recipients each year without triggering gift taxes, while lifetime gift tax exemptions allow larger transfers. Charitable giving can provide both personal satisfaction and tax benefits. Charitable remainder trusts can provide income during your lifetime while ultimately benefiting charity and reducing estate taxes. Charitable lead trusts can reduce gift taxes when transferring wealth to heirs. Generation skipping strategies can help preserve wealth for multiple generations by avoiding estate taxes at each generation. However, these strategies are complex and subject to special taxes that require careful planning. Family limited partnerships and other business structures can provide valuation discounts for gift and estate tax purposes while allowing you to maintain control over assets during your lifetime. Understanding global investment opportunities. The 41st principle is understanding global economic trends and how they create investment opportunities. The world economy is becoming increasingly interconnected, and understanding global trends can help identify investment opportunities and potential risks. Demographic trends affect economic growth and investment opportunities in different countries. Countries with young, growing populations often have higher economic growth rates, while countries with aging populations may have different investment characteristics and challenges. Technological adoption and innovation rates vary across different countries and regions. Countries that are early adopters of new technologies may have higher growth potential, while countries that lag in technology adoption may face competitive disadvantages. Natural resource availability affects economic conditions and investment opportunities. Countries with abundant natural resources may benefit from high commodity prices, while countries that are resource poor may be more dependent on technology and human capital. Political and regulatory environments affect investment conditions and risks. Countries with stable political systems and clear regulatory frameworks may provide more predictable investment environments than countries with political instability or changing regulations. Currency trends affect the value of international investments and can create opportunities for investors who understand currency dynamics. Interest rate differentials, inflation rates, and economic growth rates all affect currency values. Trade relationships and economic integration create opportunities for businesses and investors. Free trade agreements, economic unions, and other forms of economic integration can create new markets and reduce barriers to international business. Understanding emerging technologies and innovation. The 42nd principle involves understanding emerging technologies and how they create new investment opportunities and risks. Technology is changing rapidly and creating both opportunities and disruptions across many industries. Artificial intelligence and machine learning are automating many tasks and creating new capabilities that did not exist before. Companies that successfully implement these technologies may gain competitive advantages, while companies that fail to adapt may be displaced. Blockchain and cryptocurrency technologies are creating new financial systems and asset classes. While these technologies involve significant risks and regulatory uncertainties, they may also create new opportunities for wealth creation. Biotechnology and medical technologies are creating new treatments and extending human lifespans. Companies that develop successful new treatments can create enormous value, but biotechnology investing also involves high risks due to regulatory requirements and scientific uncertainties. Clean energy and environmental technologies are being driven by concerns about climate change and resource scarcity. Companies that develop efficient clean energy solutions may benefit from growing demand, but this sector also involves technological risks and depends on government policies. Internet and mobile technologies continue to evolve and create new business models and opportunities. Companies that successfully leverage these technologies to create value for customers may achieve rapid growth, but technology markets can also be highly competitive and subject to rapid changes. The key to investing in emerging technologies is understanding the underlying trends while managing the risks associated with new and unproven business models. Understanding decision-making, psychology, and biases. The 43rd principle is understanding the psychology of decision-making and how cognitive biases can affect wealth-building decisions. Human brains are not naturally wired for optimal financial decision-making, and understanding common biases can help improve investment and business decisions. Confirmation bias leads people to seek information that confirms their existing beliefs while ignoring information that contradicts those beliefs. This can lead to overconfidence in investment decisions and failure to adequately consider risks. Loss aversion causes people to feel losses more strongly than equivalent gains. This can lead to holding losing investments too long while selling winning investments too quickly, which is the opposite of optimal strategy. Recency bias leads people to give too much weight to recent events when making decisions about the future. This can cause investors to buy after markets have already risen and sell after markets have already fallen. Herd mentality causes people to follow the crowd rather than making independent decisions. This can lead to buying overvalued assets during bubbles and selling undervalued assets during panics. Anchoring bias causes people to rely too heavily on the first piece of information they receive when making decisions. This can lead to poor negotiation outcomes and inappropriate reference points for investment decisions. Understanding these biases and developing systems to counteract them can improve decision-making quality and long-term wealth-building results. Understanding diversification across multiple dimensions. The 44th principle involves understanding the importance of diversification across multiple dimensions. Diversification is often called the only free lunch in investing because it can reduce risk without necessarily reducing returns. Geographic diversification involves spreading investments across different countries and regions to reduce the impact of local economic problems. Different countries have different economic cycles, political systems, and currency exposures. Industry diversification involves spreading investments across different sectors to reduce the impact of industry-specific problems. Different industries have different growth rates, competitive dynamics, and sensitivity to economic conditions. Asset class diversification involves spreading investments across stocks, bonds, real estate, commodities, and other asset types that have different risk and return characteristics and may perform differently under various economic conditions. Time diversification involves spreading investment purchases over time rather than investing everything at once. This can reduce the impact of timing decisions and may result in better average purchase prices. Strategy diversification involves using multiple investment approaches rather than relying on a single strategy. This might involve combining growth and value strategies, active and passive management, or different risk levels within a portfolio. The key to effective diversification is understanding the correlations between different investments and ensuring that your diversification actually provides risk reduction rather than just creating complexity. Understanding liquidity and emergency fund management. The 45th principle is understanding the importance of maintaining liquidity and emergency funds. While investing for long-term growth is important for wealth building, maintaining adequate liquidity is crucial for managing unexpected expenses and taking advantage of opportunities. Emergency funds should typically cover 3 to 6 months of living expenses in easily accessible accounts like savings accounts or money market funds. This provides a cushion for unexpected job loss, medical expenses, or other financial emergencies without having to sell long-term investments at inappropriate times. Opportunity funds beyond emergency funds can allow you to take advantage of investment opportunities that arise unexpectedly. Having cash available during market downturns can allow you to buy quality investments at discounted prices. Liquidity planning involves understanding which of your investments can be converted to cash quickly and easily versus which investments may take time to sell or may have penalties for early withdrawal. Different life stages and situations require different levels of liquidity. People with stable employment and predictable expenses may need less liquidity than people with variable income or those approaching major life changes like retirement. The cost of maintaining liquidity is the lower returns typically earned on liquid investments compared to long-term investments. Finding the right balance between liquidity and growth is an important part of comprehensive wealth building. Understanding specialization and expertise development. The 46th principle involves understanding the power of specialization and becoming exceptionally skilled in valuable areas. While diversification is important for investments, specialization can be crucial for income generation. Developing deep expertise in areas that are valuable to others can command premium compensation and create opportunities that are not available to generalists. Specialization might involve technical skills like programming, engineering, or medical expertise. It might involve business skills like sales, marketing, or financial analysis. It might involve creative skills like writing, design, or entertainment. The key is choosing areas where there is strong demand and limited supply of qualified practitioners. Deep specialization often leads to recognition as an expert in your field, which can open doors to consulting opportunities, speaking engagements, board positions, and other high-value activities. Experts often command significantly higher compensation than generalists because their specialized knowledge is difficult to replace. However, specialization also involves risks because your income becomes dependent on continued demand for your particular expertise. Technology changes, market shifts, or economic disruptions could reduce demand for specialized skills. This is why many wealthy individuals combine deep specialization in their primary area with broader knowledge and skills in related areas. Building expertise requires continuous learning and staying current with developments in your field. This might involve formal education, professional certifications, attending conferences, reading industry publications, or participating in professional organizations. The investment in maintaining and advancing expertise typically provides excellent returns through higher income and better opportunities. Understanding timing in wealth-building cycles. The 47th principle is understanding the importance of timing in wealth building and how to position yourself for economic cycles and market opportunities. While timing markets perfectly is impossible, understanding general trends and cycles can help you make better decisions about when to be aggressive and when to be conservative. Economic cycles create predictable patterns of opportunity. During recessions, asset prices often decline, creating buying opportunities for those with available cash and stable income. During expansions, business opportunities increase, and it may be easier to obtain financing for new ventures or investments. Real estate markets also move in cycles, with periods of appreciation followed by periods of stagnation or decline. Understanding local market conditions, supply and demand factors, and economic trends can help identify optimal times to buy or sell properties. Stock markets experience bull and bear cycles that can last for years. While it is impossible to time these cycles perfectly, understanding valuation levels and market sentiment can help guide investment decisions. Buying quality investments when they are unpopular and undervalued often produces better returns than buying popular investments at high valuations. Interest rate cycles affect the attractiveness of different types of investments. When interest rates are low, growth investments and real estate often perform well. When interest rates are rising, bonds and other fixed income investments may become more attractive. The key to benefiting from timing is maintaining financial flexibility so you can take advantage of opportunities when they arise. This means avoiding excessive debt, maintaining cash reserves, and having income sources that are not dependent on specific market conditions. Understanding international tax strategies. The 48th principle involves understanding international tax strategies and how global mobility can affect wealth building. As wealth increases, the ability to choose where to live and conduct business can provide significant tax advantages and lifestyle benefits. Different countries have different tax rates, tax systems, and treaties that can affect your overall tax burden. Some countries have no income tax, others have low capital gains taxes, and still others provide favorable treatment for certain types of investment income. Residency and citizenship rules determine which countries have the right to tax your income and assets. Understanding these rules can help you structure your affairs to minimize overall tax burden while remaining compliant with all applicable laws. Some wealthy individuals establish residency in low-tax jurisdictions while maintaining businesses or investments in higher-tax jurisdictions. This can provide tax benefits while still allowing access to business opportunities and investment markets. International business structures like foreign corporations or trusts can provide tax advantages and asset protection benefits, but they also involve complexity and compliance requirements that require professional guidance from experts who understand international tax law. Currency diversification through international investments or foreign bank accounts can provide protection against currency devaluation and access to opportunities in different economic environments. However, international tax strategies involve significant complexity and compliance requirements. Tax laws change frequently, and what is legal in one jurisdiction may not be legal in another. Professional guidance from qualified international tax experts is essential for anyone considering these strategies. Understanding alternative business models. The 49th principle is understanding alternative business models and income streams that can provide location independence and scalability. Technology has created new ways to generate income that were not possible in previous generations. Digital products like software, online courses, ebooks, and digital art can be created once and sold repeatedly without ongoing production costs. This provides excellent scalability because each additional sale generates almost pure profit after the initial development costs are recovered. Subscription-based businesses provide recurring revenue that can be more valuable and predictable than one-time sales. Software as a service, membership sites, and subscription boxes are examples of businesses that generate ongoing revenue from customers. Affiliate marketing allows you to earn commissions by promoting other companies' products or services. This can provide income without having to create your own products or handle customer service, shipping, or other operational aspects of traditional businesses. Online marketplaces like Amazon, eBay, and Etsy allow individuals to reach global customers without building their own e-commerce infrastructure. While these platforms take commissions, they provide access to customers and tools that would be expensive to develop independently. Content creation through blogs, videos, podcasts, or social media can be monetized through advertising, sponsorships, product sales, or direct payments from fans. Building an audience takes time and effort, but successful content creators can generate substantial income from their followings. Remote services like consulting, coaching, writing, design, or programming can be delivered to clients anywhere in the world. This allows you to access global markets and potentially earn higher rates than would be available in your local market. The key to success with alternative business models is understanding your target market, providing genuine value, and building systems that can operate efficiently at scale. Many of these models require significant upfront effort before generating substantial income, but they can provide excellent long-term returns for those who persist. Understanding mentorship and learning from success. The 50th principle involves understanding the role of mentorship and learning from others who have already achieved success. Building wealth is challenging, and learning from those who have already navigated the path successfully can accelerate your progress and help you avoid common mistakes. Mentors can provide guidance based on their own experiences, introduce you to valuable contacts, and help you see opportunities that you might otherwise miss. They can also provide encouragement during difficult periods and help you maintain perspective on long-term goals. Finding mentors often requires providing value to them first. This might involve working for successful individuals, volunteering for organizations they support, or offering your skills and expertise to help with their projects. The best mentoring relationships are mutually beneficial rather than one-sided. Formal mentoring programs exist in many industries and organizations, but informal mentoring relationships that develop naturally often provide the most value. These relationships are based on mutual respect and shared interests rather than artificial structures. Reading books and studying the strategies of successful investors, entrepreneurs, and business leaders can provide many of the benefits of direct mentorship, even when personal relationships are not available. Biographies, case studies, and investment letters can provide insights into how successful people think and make decisions. Peer groups and masterminds can provide mutual mentoring where members learn from each other's experiences and provide accountability and support for achieving goals. These groups work best when members have similar ambition levels and complementary skills and experiences. Professional associations, industry conferences, and networking events can provide access to potential mentors and peer relationships. The key is approaching these interactions with a genuine interest in learning and helping others rather than just trying to get something for yourself. Understanding systems, thinking in wealth building. The 51st principle is understanding the importance of systems thinking and how different aspects of wealth building interact with each other. Wealth building is not just about individual strategies, but about how different strategies work together as a comprehensive system. Your income, expenses, savings rate, investment returns, tax efficiency, and risk management all interact to determine your overall wealth building progress. Optimizing one area without considering the others may not produce optimal overall results. For example, increasing your income is beneficial, but if the additional income pushes you into higher tax brackets without corresponding increases in tax-advantaged savings, the after-tax benefit may be less than expected. Similarly, achieving high investment returns is beneficial, but if those returns come with excessive risk that causes you to panic and sell during downturns, the long-term results may be poor. Understanding these interactions can help you identify the most impactful improvements to your overall wealth building system. Sometimes focusing on areas that seem less glamorous, like reducing expenses or improving tax efficiency, can provide better overall results than pursuing higher returns. Systems thinking also applies to business building and investment analysis. Successful businesses have systems for marketing, sales, operations, finance, and management that work together effectively. Understanding how these systems interact can help you identify strong businesses to invest in or build yourself. Economic systems at local, national, and global levels also interact in complex ways that create opportunities and risks. Understanding these broader systems can help you position your wealth building strategies to benefit from long-term trends while protecting against systemic risks. Understanding behavioral finance and market psychology. The 52nd principle involves understanding behavioral finance and how psychological factors affect financial markets and investment opportunities. Markets are not always efficient because they are driven by human emotions and psychological biases that create predictable patterns of overreaction and underreaction. Market bubbles occur when optimism and greed drive asset prices far above their fundamental values. Understanding the psychology of bubbles can help you avoid getting caught up in speculative manias and potentially profit from eventual corrections. Market panics occur when fear drives asset prices far below their fundamental values. Understanding the psychology of panics can help you maintain discipline during difficult periods and potentially take advantage of opportunities that arise when others are selling at low prices. Investor sentiment indicators can provide insights into market psychology and potential contrarian opportunities. When sentiment is extremely positive, markets may be due for corrections. When sentiment is extremely negative, markets may be due for recoveries. Seasonal patterns in markets often reflect psychological factors more than fundamental economic factors. Understanding these patterns can provide small edges in timing investment decisions, though they should not be relied upon as primary investment strategies. Cognitive biases affect individual investors and can create opportunities for those who understand and avoid these biases. Value investors like Warren Buffett have built fortunes by taking advantage of other investors' psychological mistakes. Understanding your own psychological tendencies and developing strategies to counteract them can improve your investment results. This might involve automated investing to avoid emotional decisions, having accountability partners to provide objective perspectives, or using systematic approaches that remove emotions from investment decisions. Understanding intellectual property as wealth creation. The 53rd principle is understanding the importance of intellectual property and how knowledge-based assets can create lasting wealth. In an increasingly knowledge-based economy, intellectual property can be one of the most valuable and durable assets you can create. Patents protect inventions and can provide licensing income for many years. While obtaining patents requires significant time and expense, successful patents can generate substantial royalty income with minimal ongoing effort. Copyrights protect creative works like books, music, software, and art. Successful creative works can generate income through sales, licensing, and royalties for decades after they are created. Trademarks protect brand names and can become extremely valuable as businesses grow and gain recognition. Strong brands can command premium prices and create competitive advantages that are difficult for competitors to replicate. Trade secrets protect valuable business information and processes that provide competitive advantages. Unlike patents, trade secrets can potentially provide protection indefinitely as long as the information remains secret. Creating intellectual property often requires significant upfront investment of time and effort before generating income. However, intellectual property can provide some of the best examples of passive income because it can continue generating revenue long after the initial work is completed. Licensing intellectual property to others can provide income without requiring you to build businesses or marketing capabilities yourself. This can be particularly valuable for inventors and creators who prefer to focus on developing new ideas rather than commercializing existing ones. The digital economy has made it easier for individuals to create and monetize intellectual property. Software, digital content, and online courses can be created by individuals and distributed globally without traditional publishing or manufacturing infrastructure. Understanding family wealth dynamics. The 54th principle involves understanding family wealth dynamics and how to prepare future generations to handle inherited wealth responsibly. Building significant wealth creates opportunities and responsibilities that extend beyond your own lifetime. Many wealthy families lose their wealth within 2 or 3 generations because heirs are not prepared to manage it effectively. This pattern is so common that there are sayings like shirt sleeves to shirt sleeves in 3 generations that describe this phenomenon. Preparing heirs for wealth inheritance involves education about financial management, business principles, and the responsibilities that come with wealth. This education should begin early and continue throughout their development. Involving children and other heirs in family business and investment decisions can provide practical experience and help them develop the skills and judgment needed to manage wealth effectively. Family governance structures like family councils, family constitutions, and family mission statements can help establish shared values and decision-making processes that guide how wealth is managed across generations. Trusts and other legal structures can provide professional management and controls that help protect inherited wealth while allowing beneficiaries to benefit from it. These structures can also provide incentives for beneficiaries to pursue education, careers, and other productive activities. Teaching philanthropy and community involvement can help heirs understand the broader purposes and responsibilities of wealth beyond personal consumption. Many wealthy families find that giving away money can be more challenging and rewarding than making money. Professional family wealth advisors who specialize in working with wealthy families can provide guidance and services that go beyond traditional investment management to address the unique challenges of family wealth. Understanding geopolitical trends and investment impact. The 55th principle is understanding geopolitical trends and how they create investment opportunities and risks. Political developments, policy changes, and international relationships can significantly affect economic conditions and investment returns. Government fiscal and monetary policies affect economic growth, inflation, interest rates, and currency values. Understanding these policies and their likely effects can help guide investment decisions and risk management strategies. Regulatory changes can create opportunities for some businesses while creating challenges for others. Staying informed about regulatory trends in industries where you have investments or business interests can help you anticipate and adapt to changes. International trade policies and agreements affect global business conditions and can create opportunities for companies that benefit from increased trade or challenges for companies that face increased competition. Military conflicts and geopolitical tensions can affect commodity prices, currency values, and investor sentiment. While these events are difficult to predict, understanding their potential impacts can help with risk management and positioning. Demographic and social trends affect long-term economic conditions and create opportunities in some sectors while creating challenges in others. Aging populations, urbanization, climate concerns, and technological adoption all create long-term investment themes. Election cycles and political changes can affect market sentiment and policy expectations. While markets tend to perform well over long periods regardless of political changes, understanding political cycles can help with shorter-term positioning and risk management. The key to incorporating geopolitical analysis into wealth building is focusing on long-term trends rather than trying to predict short-term events, and maintaining diversification to reduce exposure to any single political or economic system. Understanding luck and randomness in wealth building. The 56th principle involves understanding the role of luck and randomness in wealth building and how to position yourself to benefit from positive surprises while protecting against negative ones. While skill and strategy are important, luck also plays a significant role in financial success. Being in the right place at the right time can create opportunities that lead to significant wealth. However, you can increase your chances of being lucky by putting yourself in situations where good things can happen to you. Networking widely, staying informed about trends and opportunities, maintaining financial flexibility to act when opportunities arise, and being willing to try new things all increase your chances of encountering lucky breaks. Diversification across investments, income sources, and strategies helps protect against bad luck in any particular area, while ensuring that you can benefit from good luck wherever it occurs. Maintaining adequate insurance, emergency funds, and conservative financial practices helps protect against the negative effects of bad luck while preserving your ability to continue building wealth over time. Understanding that luck plays a role in success can help maintain humility and encourage continued learning and effort. People who attribute their success entirely to skill may become overconfident and take excessive risks that lead to losses. It can also encourage generosity and social responsibility. People who understand that luck contributed to their success may be more willing to help others and contribute to their communities. Understanding health and longevity in financial planning. The 57th principle is understanding the importance of health and longevity in wealth building. Living longer and remaining healthy throughout your life can significantly impact your wealth building potential and your ability to enjoy the wealth you accumulate. Healthcare costs tend to increase with age and can represent significant expenses that reduce accumulated wealth. Investing in preventive healthcare, maintaining healthy lifestyles, and having adequate health insurance can help control these costs. Remaining productive for more years through good health can significantly increase lifetime earnings. People who remain healthy and capable of working into their 70s or 80s can earn significantly more over their lifetimes than those who must stop working due to health problems in their 50s or 60s. Cognitive health is particularly important for managing investments and making good financial decisions throughout your life. Mental decline can lead to poor financial decisions or make you vulnerable to financial exploitation. Physical health affects your ability to pursue active investment strategies like real estate management or business ownership that require time and energy. It also affects your quality of life and ability to enjoy the wealth you accumulate. Longevity planning becomes increasingly important as life expectancies increase. People who live into their 90s or beyond may need their wealth to last much longer than previous generations, which affects retirement planning and investment strategies. Advances in medical technology and treatments may extend healthy lifespans significantly in coming decades. People who position themselves to benefit from these advances may have much longer wealth building and wealth enjoying periods than current projections suggest. Understanding purpose and motivation in wealth building. The 58th principle involves understanding the relationship between purpose and wealth building. Having clear purposes and motivations beyond just accumulating money can provide the sustained motivation needed for long-term wealth-building success. People who are motivated primarily by fear or scarcity mindsets may make conservative decisions that limit their wealth-building potential. People who are motivated by positive visions of what they want to accomplish with wealth often take more appropriate risks and persist through challenges. Having purposes that extend beyond personal consumption can provide motivation to build wealth even after you have enough for your own needs. This might involve supporting family members, contributing to causes you care about, or creating businesses that solve important problems. Clear purposes can also guide decision-making about how much risk to take, which opportunities to pursue, and how to balance wealth building with other life priorities. Without clear purposes, it can be difficult to know when you have enough or how to make trade-offs between different goals. Many successful wealth builders find that their most satisfying accomplishments involve using their wealth to make positive impacts on others rather than just personal consumption. This sense of purpose can provide motivation to continue building and managing wealth effectively throughout their lives. Purpose can also help maintain perspective during difficult periods. Wealth building inevitably involves setbacks and disappointments, and having clear purposes can help maintain motivation to continue working toward long-term goals. Understanding continuous adaptation and strategy evolution. The 59th principle is understanding the importance of continuous adaptation and evolution in wealth-building strategies. What works in one period may not work in another due to changing economic conditions, technological developments, regulatory changes, and life circumstances. Successful wealth builders tend to be lifelong learners who continuously update their knowledge and adapt their strategies based on new information and changing conditions. This requires maintaining intellectual curiosity and openness to new ideas throughout your life. Technology continues to create new opportunities and disrupt existing business models. Staying informed about technological trends and their potential impacts can help you identify opportunities and avoid investments that may be displaced by technological change. Economic conditions change over time, and strategies that work well during periods of low inflation and interest rates may not work as well during periods of high inflation or rising interest rates. Understanding these changes and adapting accordingly is crucial for long-term success. Tax laws and regulations change frequently, and strategies that are tax-efficient today may not be tax-efficient in the future. Staying informed about regulatory changes and working with qualified advisors can help ensure that your strategies remain effective over time. Personal circumstances also change throughout life. Strategies that are appropriate for young people with high risk tolerance may not be appropriate for older people approaching retirement. Family situations, health conditions, and career changes all require adjustments to wealth-building strategies. The key to successful adaptation is maintaining flexibility in your approach while staying focused on your long-term goals. This might involve regularly reviewing and updating your strategies, maintaining relationships with advisors who can provide current expertise, and being willing to make changes when circumstances warrant them. Understanding compound growth, timing, and patience. The 60th principle involves understanding the role of timing and patience in compound growth. While starting early is important, it is never too late to begin building wealth, and understanding the mathematics of compound growth can help maintain motivation and make better decisions. Compound growth becomes more powerful over longer time periods, but it can also produce significant results even over shorter periods if growth rates are high enough. Understanding this relationship can help you make decisions about how much risk to take and how much to save based on your time horizon. Even small improvements in growth rates can have dramatic impacts over long periods due to the exponential nature of compound growth. This means that efforts to improve investment returns, reduce expenses, or increase savings rates can have much larger impacts than they initially appear. The early years of compound growth often show modest results, which can be discouraging for people who expect immediate gratification. Understanding that compound growth accelerates over time can help maintain discipline during the early years when progress seems slow. Interrupting compound growth by withdrawing funds or stopping contributions can have dramatic negative impacts on long-term results. This is why maintaining discipline during difficult periods and avoiding the temptation to spend investment gains is crucial for building wealth. Starting multiple compound growth processes simultaneously can accelerate overall wealth building. This might involve building businesses while also investing in financial assets, developing skills while also building investment portfolios, or creating multiple income streams that can each grow over time. Understanding financial education's societal impact. The 61st principle is understanding the importance of financial education for society and how widespread financial literacy can create better opportunities for everyone. Your own wealth-building success can be enhanced by living in a society where more people understand financial principles and make good financial decisions. Societies with higher levels of financial literacy tend to have more stable economies, better functioning financial markets, and more opportunities for entrepreneurship and investment. This creates better conditions for wealth building for everyone. Financially literate populations make better decisions about saving, investing, and debt management, which reduces systemic financial risks that can affect entire economies. This reduces the likelihood of financial crises that can destroy wealth across entire societies. Supporting financial education initiatives in your community can help create more financial opportunities for others, while also creating better economic conditions that benefit your own wealth-building efforts. This might involve volunteering to teach financial literacy, supporting educational programs, or advocating for better financial education in schools. Teaching financial principles to employees, customers, and business partners can improve their financial situations while also creating better business relationships and opportunities. Financially stable employees and customers are generally more valuable than those who are struggling financially. Sharing your knowledge and experience with others who are beginning their wealth-building journeys can help them succeed while also reinforcing and expanding your own understanding of financial principles. Understanding the relationship between wealth and happiness. The 62nd principle involves understanding the relationship between wealth and happiness and how to optimize both simultaneously. While money does not guarantee happiness, financial security can provide a foundation that makes it easier to pursue other sources of fulfillment. Research suggests that income increases happiness up to a certain level that covers basic needs and provides security. But beyond that level, additional income has diminishing returns on happiness. Understanding this relationship can help guide decisions about how much wealth to pursue and how much time and energy to spend on wealth building versus other pursuits. The process of building wealth can provide satisfaction and sense of accomplishment that contribute to happiness independently of the wealth itself. Setting and achieving financial goals, developing new skills, solving problems, and creating value for others can all provide intrinsic satisfaction. However, pursuing wealth at the expense of health, relationships, and personal fulfillment can reduce overall life satisfaction, even if the wealth-building efforts are financially successful. Finding the right balance requires understanding your own values and priorities. Using wealth to create experiences, help others, and pursue meaningful goals often provides more satisfaction than using wealth primarily for consumption or status. This suggests that considering how you will use wealth can be as important as how you build it. Many wealthy individuals find that their greatest satisfaction comes from the positive impacts they can make on others rather than from personal consumption. This might involve family financial security, charitable giving, job creation through business building, or other forms of contribution to society. Understanding global demographic trends. The 63rd principle is understanding global demographic trends and how they create long-term investment opportunities and challenges. Major demographic shifts are creating changes in economic conditions, consumer demand, and investment opportunities that will play out over decades. Aging populations in developed countries are creating increased demand for healthcare services, retirement housing, and financial services, while reducing the workforce available to support retirees. This creates investment opportunities in companies that serve older populations while creating challenges for economic growth and government finances. Younger populations in developing countries are creating increased demand for education, housing, consumer goods, and job opportunities. This creates investment opportunities in companies that serve growing populations while also creating opportunities for economic growth in those regions. Urbanization trends are creating increased demand for urban housing, transportation, and infrastructure while reducing demand for rural properties and services. This creates opportunities for real estate investors and companies that serve urban populations. Changes in family structures and lifestyle preferences are affecting demand for different types of housing, financial services, and consumer products. Understanding these trends can help identify investment opportunities and avoid investments in declining sectors. Education and skill level trends affect economic productivity and investment opportunities. Countries and regions that are improving education and skill levels may provide better long-term investment opportunities than those where education and skills are stagnating. Understanding infrastructure and technology adoption. The 64th principle involves understanding the role of infrastructure and technology adoption in creating regional investment opportunities. The availability of high-quality infrastructure and the rate of technology adoption can significantly affect economic growth and investment opportunities in different areas. Transportation infrastructure, including roads, airports, and ports, affects the ability of businesses to operate efficiently and reach markets. Areas with improving infrastructure may provide better investment opportunities than areas where infrastructure is deteriorating. Communication infrastructure, including internet connectivity and mobile networks, affects the ability of businesses to operate in the modern economy. Areas with advanced communication infrastructure may attract businesses and investment, while areas with poor communication infrastructure may be left behind. Energy infrastructure, including reliable electricity and clean energy sources, affects business costs and environmental sustainability. Areas that are transitioning to clean energy may provide investment opportunities, while areas that remain dependent on expensive or polluting energy sources may face challenges. Educational infrastructure, including schools and universities, affects the availability of skilled workers and the ability of areas to attract knowledge-based businesses. Areas with strong educational infrastructure may provide better long-term investment opportunities. Financial infrastructure, including banks, capital markets, and payment systems, affects the ability of businesses to access capital and operate efficiently. Areas with well-developed financial infrastructure may provide better conditions for business investment and economic growth. Understanding scenario planning for multiple futures. The 65th principle is understanding the importance of scenario planning and preparing for multiple possible futures. The future is uncertain, and preparing for different possibilities can help ensure that your wealth-building strategies remain effective, regardless of which scenarios actually occur. Economic scenarios might include continued growth, recession, inflation, deflation, or stagflation. Different economic conditions favor different types of investments and strategies, so understanding these relationships can help with portfolio construction and risk management. Technological scenarios might include continued gradual change, breakthrough innovations that transform entire industries, or technological disruptions that make current skills and investments obsolete. Staying informed about technological trends and maintaining flexibility can help adapt to these changes. Political scenarios might include continued political stability, major policy changes, international conflicts, or changes in international trade relationships. Understanding how political changes might affect your investments and income sources can help with risk management and positioning. Personal scenarios might include continued good health, serious illness, job loss, inheritance, or major family changes. Planning for these possibilities through insurance, emergency funds, and flexible investment strategies can help ensure that your wealth building continues regardless of personal circumstances. The key to effective scenario planning is not trying to predict which scenario will occur, but rather ensuring that your strategies are robust enough to perform reasonably well under a range of possible conditions. Understanding the mathematics of wealth building. The 66th principle involves understanding the mathematics of wealth building and how small changes in key variables can have dramatic impacts on long-term results. Understanding these mathematical relationships can help you focus your efforts on the factors that have the greatest impact. The formula for compound growth is future value equals present value times 1 plus interest rate raised to the power of time periods. Small changes in any of these variables can have large impacts on the final result, especially over long time periods. Increasing your savings rate by just a few percentage points can significantly accelerate wealth building. For example, increasing your savings rate from 10% to 15% represents a 50% increase in the amount being invested, which can reduce the time needed to reach financial goals by many years. Improving investment returns by even 1 or 2 percentage points annually can have dramatic impacts over long periods. However, pursuing higher returns often involves higher risks, so the relationship between risk and return must be carefully considered. Starting earlier provides more time for compound growth to work, and each year of delay can require significantly higher savings rates to achieve the same results. This is why financial education and early action are so valuable for wealth building. Tax efficiency can significantly impact after-tax wealth accumulation. Reducing your effective tax rate by even a few percentage points can increase your wealth building rate substantially over time. Controlling expenses and avoiding lifestyle inflation can increase the amount available for saving and investing. Small reductions in ongoing expenses can free up money for investment that compounds over many years. Understanding work-life balance in wealth creation. The 67th principle is understanding the importance of maintaining work-life balance throughout your wealth-building journey. Building wealth is important, but it should not come at the expense of your health, relationships, or personal fulfillment. Overwork and excessive stress can lead to health problems that create medical expenses and reduce your ability to earn income and make good decisions. Maintaining reasonable work schedules and managing stress can actually improve long-term wealth-building results. Neglecting relationships with family and friends can reduce your quality of life and may also reduce opportunities for business partnerships, referrals, and other forms of mutual support that can enhance wealth building. Pursuing interests and hobbies outside of work and investing can provide mental stimulation, stress relief, and sometimes unexpected business opportunities. Many successful entrepreneurs have discovered business opportunities through personal interests and activities. Taking time for rest and reflection can improve decision-making quality and help you maintain perspective on long-term goals. The constant pressure to be productive can sometimes lead to poor decisions that harm long-term wealth-building efforts. Wealth building is a marathon rather than a sprint, and maintaining balance can help ensure that you have the energy and motivation to persist through the inevitable challenges and setbacks that occur along the way. Remember that the ultimate goal of building wealth is to create options and opportunities for yourself and others. If the process of building wealth prevents you from enjoying life or contributing positively to others, you may want to reconsider your approach and find better balance. Understanding innovation and creativity in wealth building. The 68th principle involves understanding the role of innovation and creativity in wealth creation. Many of the greatest fortunes have been built by people who found creative solutions to important problems or who innovated in ways that created new value for customers. Innovation can involve developing new products or services, finding better ways to deliver existing products or services, or creating entirely new business models that serve customer needs more effectively than existing approaches. Creativity in investment and business strategies can also create wealth-building opportunities that are not available to people who follow conventional approaches. This might involve finding undervalued assets that others have overlooked, combining different strategies in new ways, or identifying trends before they become widely recognized. However, innovation and creativity also involve higher risks because unproven approaches may not work as expected. Balancing creative experimentation with proven strategies can help capture the benefits of innovation while managing the associated risks. Innovation often requires significant time and effort before producing results, and many innovative attempts fail completely. Having the financial resources and risk tolerance to pursue innovative approaches while maintaining other income and investment sources can provide the best of both worlds. Staying informed about developments in technology, business models, and market trends can help identify opportunities for innovation and creativity. Reading widely, networking with diverse groups of people, and maintaining curiosity about how things work can spark innovative ideas. Understanding legacy, thinking, and long-term impact. The 69th principle is understanding the importance of legacy thinking and how your wealth-building efforts can create positive impacts that extend far beyond your own lifetime. Building wealth with a legacy mindset can provide additional motivation and help guide decisions about how to build and use wealth. Legacy thinking involves considering how your wealth-building efforts will affect future generations of your family. This might involve building businesses that can be passed to children, creating investment portfolios that can provide ongoing income for multiple generations, or establishing educational funds that can help family members develop their own wealth-building capabilities. It also involves considering how your wealth-building efforts can contribute to your community and society. This might involve creating jobs through business building, supporting charitable causes, or investing in ways that promote economic development and social progress. Environmental legacy involves considering how your wealth-building activities affect environmental sustainability and climate change. This might influence investment decisions, business strategies, and charitable giving priorities. Knowledge legacy involves sharing what you learn throughout your wealth-building journey with others who can benefit from your experience. This might involve mentoring, teaching, writing, or supporting educational initiatives that help others build wealth and achieve financial security. Legacy thinking can help provide motivation to continue building wealth even after you have achieved personal financial security. It can also help guide decisions about risk management and wealth preservation to ensure that your legacy objectives can be achieved. Understanding personal development through wealth building. The 70th principle involves understanding the relationship between wealth and personal development. The process of building wealth often requires developing personal qualities and capabilities that are valuable in all areas of life. Discipline and delayed gratification are essential for wealth building and are also valuable for achieving goals in health, relationships, education, and other areas of life. The habits developed through wealth building can improve overall life effectiveness. Critical thinking and analytical skills developed through investment analysis and business decision-making can improve decision-making quality in all areas of life. Learning to evaluate risks and opportunities objectively is a valuable life skill. Communication and relationship skills developed through business and investment activities can improve personal relationships and create opportunities in all areas of life. Learning to work effectively with others is valuable, regardless of your wealth-building success. Leadership skills developed through business building can be valuable in community involvement, family relationships, and other areas where the to organize and motivate others is important. Resilience and perseverance developed through navigating the inevitable challenges of wealth building can help you handle other life challenges more effectively. Learning to persist through setbacks is valuable in all areas of life. Conversely, personal development in areas like health, relationships, and emotional intelligence can support wealth-building success by improving decision-making, providing emotional stability during challenging periods, and creating opportunities through stronger relationships with others. Understanding continuous risk assessment and management. The 71st principle is understanding the importance of continuous risk assessment and management throughout your wealth-building journey. Risk management is not something you do once and forget about, but rather an ongoing process that requires regular attention and adjustment. Risk tolerance can change over time as your wealth grows, your life circumstances change, and your goals evolve. Regularly reassessing your risk tolerance and adjusting your strategies accordingly can help ensure that your approach remains appropriate for your current situation. New types of risks emerge as economic conditions, technology, and regulations change. Staying informed about emerging risks and adjusting your strategies to address them can help protect your wealth and continue building effectively. Concentration risk increases as your wealth grows and becomes more concentrated in particular investments, business interests, or geographic areas. Regular diversification reviews can help identify and address concentration risks before they become problems. Liquidity risk can change as your investment portfolio evolves and your cash flow needs change. Regularly assessing your liquidity position and maintaining appropriate emergency funds and liquid investments can help ensure that you can meet unexpected expenses without disrupting long-term investment strategies. Inflation risk affects all wealth-building efforts over long time periods. Regularly reviewing your portfolio's inflation protection and adjusting as needed can help ensure that your wealth maintains its purchasing power over time. Understanding psychological pricing and consumer behavior. The 72nd principle of wealth creation involves understanding the profound and multifaceted power of psychological pricing in every aspect of your business ventures, investment decisions, and financial transactions. When you price products at $9.99 instead of $10, you tap into a fundamental aspect of human psychology that makes purchases feel dramatically more affordable and accessible to potential customers. This seemingly simple technique, backed by decades of consumer psychology research, can increase your sales conversion rates by up to 30% in many industries and market segments, representing potentially thousands or even millions of dollars in additional revenue over time. The human brain processes numbers from left to right, giving disproportionate weight to the first digit encountered in any price, so $9.99 feels significantly cheaper than $10, even though the mathematical difference is merely 1 cent. This psychological phenomenon, known as the left-digit bias, extends far beyond simple retail pricing strategies to subscription models where $29 per month feels substantially more accessible than $30, to service pricing where $495 seems much more reasonable than $500, and even to salary negotiations where asking for $49,900 might be more palatable than $50,000 in certain negotiation contexts. The principle works because it exploits the way our brains have evolved to make quick decisions with limited cognitive resources, creating mental shortcuts that can be leveraged ethically to increase sales and profitability. Master this psychological trigger by testing different price points systematically across your products and services, analyzing customer response rates and conversion data, conducting focus groups to understand customer perception, and understanding that the perception of value is often more important than actual mathematical value in purchasing decisions. Implement this principle by ending prices in 9, using tiered pricing structures that make your preferred option seem like the obvious choice, offering payment plans that break large amounts into smaller psychological chunks, and always considering how your pricing appears to customers rather than just focusing on your desired profit margins. Watch your revenue increase substantially without changing the fundamental value proposition you provide to customers, while maintaining ethical business practices that serve your customers well. Understanding scalable systems and automation. The 73rd principle focuses intensively on the critical importance of building robust, scalable systems and automated processes that generate income and create substantial value without requiring your constant personal involvement, direct supervision, or active daily management. Wealthy individuals understand at a fundamental level that time is their most precious and irreplaceable resource, and they systematically create businesses, investments, and income streams that generate money even while they sleep, travel, spend time with family, or focus their attention on other high-priority activities. This fundamental shift from trading time directly for money to creating systems that work independently represents one of the most important and transformative transitions in wealth building, separating those who build lasting wealth from those who remain trapped in cycles of active income generation. These wealth-generating systems might include comprehensive online courses that sell automatically through sophisticated marketing funnels and email sequences, rental properties that generate consistent monthly cash flow through professional property management companies, established businesses with capable managers and detailed standard operating procedures that handle daily operations, diversified investment portfolios that generate dividends and long-term appreciation, licensing deals that provide ongoing royalty payments, affiliate marketing systems that generate commissions, franchise operations that produce passive income, digital products that sell repeatedly without additional production costs, and subscription-based services that create predictable recurring revenue streams. Start building these systems by identifying one aspect of your current income generation that could be systematized or automated, whether that means creating templates for repetitive tasks, hiring virtual assistants to handle routine activities, developing standard operating procedures for business processes, or investing in technology that automates manual work. Gradually expand your systematic approach until you have multiple income streams that require minimal daily oversight while maintaining quality standards and customer satisfaction. The goal is not to become completely hands-off immediately, but to progressively reduce your direct involvement while maintaining or improving results, creating optionality and freedom in how you spend your time and energy. Understanding deep market psychology and customer behavior. The 74th principle emphasizes the absolutely critical importance of understanding your target market at a deep psychological and emotional level that goes far beyond basic demographic information or surface-level preferences. Successful entrepreneurs and wealth builders do not just know what their customers buy, they understand intimately why they buy, when they are most likely to make purchasing decisions, how they research and evaluate options, what emotional triggers motivate their spending, what fears and desires drive their behavior, what language and messaging resonates most powerfully with them, and what underlying problems they are truly trying to solve through their purchases. This profound market understanding involves studying consumer psychology principles, conducting detailed surveys and interviews with existing and potential customers, analyzing purchase patterns and customer behavior data, spending significant time directly interacting with your ideal customers in their natural environments, and developing detailed customer personas that capture not just demographic information, but psychological profiles, emotional drivers, and behavioral patterns. The more intimately and comprehensively you understand your target market, the better you can position your products and services to meet their exact needs in ways that feel personally relevant and valuable to them. This deep market knowledge allows you to charge premium prices because you are solving real problems in ways that truly resonate with your audience, communicate in language that speaks directly to their concerns and aspirations, create products that address their specific pain points, and build marketing messages that feel like you are reading their minds rather than trying to sell them something. Develop this understanding by creating opportunities for regular customer interaction, analyzing customer feedback systematically, studying successful competitors to understand what appeals to your shared market, testing different messages and approaches to see what generates the strongest response, and continuously refining your understanding as markets evolve and change over time. Remember that markets are made up of individual people with complex motivations, not abstract demographic categories. And the more you can understand and empathize with these individual human experiences, the more successful your wealth-building efforts will become. Understanding content marketing and authority building. The 75th principle involves strategically leveraging the tremendous power of content marketing to build authority, establish trust, and attract ideal customers without expensive traditional advertising or aggressive sales tactics. In today's digital economy, valuable content acts as a powerful magnet that draws potential customers to your business naturally and positions you as a trusted expert in your field. This content could take many forms, including detailed blog posts that solve common problems in your industry, educational videos that teach useful skills and provide valuable insights, informative podcasts that share expertise and interview other experts, engaging social media content that entertains while educating, comprehensive guides and resources that address complex topics, webinars that provide in-depth training, email newsletters that deliver consistent value, and case studies that demonstrate real-world results. The key to successful content marketing lies in consistency of publication, genuine value provided to your audience, and strategic alignment with your business goals and customer needs. When you regularly publish content that genuinely helps people solve problems, learn new skills, or achieve their goals, you build substantial trust and credibility that translates directly into sales when people are ready to make purchasing decisions. Content marketing represents an investment of time and expertise rather than large amounts of money, making it accessible to anyone willing to invest consistent effort into creating valuable material that serves their target audience. Start by identifying the most common questions, problems, and challenges faced by your ideal customers. Then create content that addresses these issues comprehensively and helpfully. Focus on providing genuine value rather than constantly trying to sell, understanding that people will seek out your products and services naturally when they trust your expertise and believe you can help them achieve their goals. Track which content performs best in terms of engagement, shares, and conversions, then create more content in those successful formats and topics. Over time, your content library becomes a valuable business asset that continues attracting customers and generating sales long after the initial creation effort.
Understanding compound growth in all life areas.
The 76th principle centers on understanding and strategically utilizing the mathematical power of compound growth in every area of your wealth-building activities. Recognizing that small, consistent improvements compound exponentially over time to create dramatic results. Just as money compounds when invested wisely at reasonable rates of return, skills compound when developed consistently through deliberate practice. Professional networks compound when nurtured regularly through genuine relationship building. Businesses compound when improved continuously through systematic optimization, and knowledge compounds when acquired steadily through lifelong learning. The mathematical reality of compound growth means that a small improvement of just 1% daily results in being 37 times better over the course of a single year, while a 5% improvement compounds to over 14 times better annually. This mathematical principle applies to everything from developing expertise in valuable skills to improving business processes and systems, to building customer relationships and reputation, to increasing investment returns through better decision-making. Focus on making consistent small improvements rather than attempting dramatic changes that are difficult to maintain over time, understanding that the compound effect works slowly and almost imperceptibly at first, but accelerates dramatically over extended periods, creating exponential rather than linear growth in your wealth-building efforts and overall results. Implement this principle by identifying key areas where small improvements could compound over time, such as learning new skills for 30 minutes daily, improving business processes by 1% each week, expanding your professional network by meeting one new person each week, or increasing your savings rate by small amounts regularly. Track your progress systematically to maintain motivation during the slow initial phase when results are not yet visible, and maintain faith in the mathematical certainty that consistent small improvements will eventually create dramatic results. The key is patience combined with persistent action, understanding that most people give up during the slow initial phase just before the compound effect begins accelerating dramatically.
Understanding strategic partnerships and joint ventures.
The 77th principle involves systematically mastering the art and science of strategic partnerships and mutually beneficial joint ventures that leverage other people's strengths, resources, and market access to accelerate your wealth building efforts exponentially. Wealthy individuals and successful entrepreneurs rarely build their fortunes in complete isolation, instead collaborating intelligently with others who possess complementary skills, established customer bases, financial resources, or market access that would take years to develop independently. These strategic collaborations could mean partnering with someone who has strong technical skills while you provide marketing expertise and business development capabilities, joining forces with an established company that serves the same target market with different but complementary products or services, collaborating with influencers or thought leaders who have access to your ideal customers, or forming alliances with businesses in related industries that can refer customers to each other. Strategic partnerships and joint ventures allow you to leverage other people's existing strengths and resources, share risks and costs associated with new ventures, access opportunities and markets that would be difficult or impossible to pursue alone, and accelerate growth by combining complementary capabilities. The key to successful partnerships lies in creating genuine win-win arrangements where all parties benefit significantly from the collaboration, clearly defining roles and responsibilities, establishing fair compensation structures, and maintaining open communication throughout the relationship. Start by conducting an honest assessment of your unique strengths and capabilities, then actively look for individuals and organizations whose strengths complement your weaknesses and whose weaknesses align with your strengths. Approach potential partners with specific proposals that clearly articulate the mutual benefits and demonstrate how the collaboration will help them achieve their goals while advancing yours. Structure partnerships with clear agreements that protect everyone's interests while maintaining flexibility to adapt as circumstances change.
Understanding multiple income stream development.
The 78th principle focuses on the fundamental importance of systematically developing multiple streams of income, rather than relying dangerously on a single source of revenue. Understanding that diversified income streams provide both financial security and accelerated wealth-building opportunities. While your primary job or business might generate the majority of your income initially, gradually developing additional income streams creates financial resilience that protects you from economic downturns, industry disruptions, or unexpected changes in your primary income source. These additional income streams might include rental income from real estate investments, dividends from stock market investments, royalties from creative work or intellectual property, affiliate marketing commissions from promoting products you believe in, consulting fees from sharing your expertise, income from side businesses that complement your main focus, speaking fees from sharing your knowledge at events, online course sales from teaching your skills, licensing fees from allowing others to use your systems or processes, or investment returns from lending money or participating in investment partnerships. The goal is not to dilute your focus by pursuing too many opportunities simultaneously, but to systematically build additional income sources that complement and reinforce your primary wealth-building activities. Each new income stream typically starts small, but has the potential to grow significantly over time, and the combination of multiple streams creates exponential wealth-building potential. Begin by identifying skills, knowledge, or resources you already possess that could generate additional income with minimal additional time investment. Focus on developing one additional income stream at a time until it becomes profitable and relatively self-sustaining, then gradually add others as your capacity and experience grow. Maintain your primary income source as the foundation while building additional streams that eventually could replace or exceed your primary income if necessary.
Understanding strategic credit and debt management.
The 79th principle emphasizes the critical importance of maintaining excellent credit scores and understanding how to use debt strategically as a wealth-building tool rather than a financial burden. While avoiding unnecessary consumer debt for purchases that do not generate income is financially wise, wealthy individuals understand that properly used debt can dramatically accelerate wealth building when the borrowed money generates more income than the cost of borrowing. This strategic use of debt includes mortgages for purchasing income-producing real estate properties, business loans for expanding profitable operations, lines of credit for taking advantage of time-sensitive investment opportunities, or equipment financing for purchasing assets that increase earning capacity. The fundamental principle is ensuring that any debt you assume generates more income or appreciation than it costs in interest payments and associated fees, creating positive leverage that amplifies your returns rather than creating a drain on your resources. Maintain an excellent credit score by paying all bills on time without exception, keeping credit utilization ratios low on all credit cards, maintaining older credit accounts to demonstrate credit history, monitoring your credit report regularly for errors or unauthorized activity, and avoiding unnecessary credit inquiries that can temporarily lower your score. Good credit opens doors to better interest rates and larger borrowing opportunities, while poor credit limits your options significantly and increases borrowing costs substantially, making strategic debt use more difficult or impossible. Work with qualified financial professionals to understand the tax implications of different types of debt, structure borrowing in ways that optimize tax benefits, and ensure that your debt service obligations remain manageable even during economic downturns or temporary income reductions. The goal is using debt as a tool for wealth building rather than allowing debt to control your financial future. Understanding comprehensive tax optimization. The 80th principle involves developing comprehensive understanding and strategic implementation of tax optimization strategies to legally minimize your tax burden and keep significantly more of what you earn and generate through investments. Wealthy individuals work closely with qualified tax professionals, including certified public accountants and tax attorneys, to structure their income, investments, and business activities in ways that minimize taxes while remaining fully compliant with all applicable tax laws and regulations. This sophisticated tax planning includes maximizing contributions to tax-advantaged retirement accounts, such as traditional and Roth IRAs, solo 401k plans for self-employed individuals, and employer-sponsored retirement plans. Understanding the significant differences between ordinary income tax rates and more favorable capital gains tax treatment, utilizing legitimate business deductions for equipment, travel, education, and other business-related expenses, timing the recognition of income and expenses strategically to optimize tax outcomes across multiple years, and considering the tax implications of investment decisions, including asset location strategies that place different types of investments in accounts with appropriate tax treatment. Tax planning and optimization is not about avoiding taxes illegally or using questionable strategies that might trigger audits or penalties, but about using legitimate strategies established by tax law to minimize your overall tax burden while staying fully compliant with all regulations and requirements. The money you save through proper tax planning and strategy can be invested to generate additional wealth, creating a compound benefit that grows significantly over time. Begin by working with qualified tax professionals to understand your current tax situation and identify immediate opportunities for improvement. Then develop longer-term strategies that align tax optimization with your overall wealth-building goals. Keep detailed records of all tax-related transactions and decisions, stay informed about changes in tax laws that might affect your strategies, and review your tax planning regularly to ensure it remains optimal as your financial situation evolves and tax laws change. Understanding advanced negotiation skills. The 81st principle centers on developing sophisticated negotiation skills that create value for all parties involved, while securing favorable outcomes that advance your wealth-building objectives. Whether negotiating salaries and employment terms, structuring business deals and partnerships, purchasing real estate or other investments, contracting for services, or resolving disputes, the ability to negotiate effectively can save and earn you hundreds of thousands or even millions of dollars throughout your lifetime. Effective negotiation is not about winning at the expense of others or using manipulative tactics, but about finding creative solutions that provide genuine value to everyone involved while optimizing outcomes for yourself. This approach requires thorough preparation, including research on market conditions and comparable situations, deep understanding of the other party's needs, motivations, and constraints, creative problem-solving that identifies mutually beneficial solutions, clear communication of your own needs and limitations, and patience to work through complex issues systematically. Develop your negotiation skills by practicing in low-stakes situations to build confidence and experience. Studying negotiation techniques and psychology, observing skilled negotiators in action, and reflecting on your own negotiation experiences to identify areas for improvement. Remember that almost everything in business and life is negotiable to some degree, and failing to negotiate often means leaving significant money on the table unnecessarily. Approach negotiations with a collaborative mindset focused on creating value rather than an adversarial approach focused on defeating the other party. Prepare multiple options and alternatives before entering important negotiations. Understand your walk-away point and be willing to walk away from deals that do not meet your minimum requirements. The confidence that comes from being prepared to walk away from unfavorable deals often leads to much better outcomes than desperate acceptance of whatever terms are offered.
Understanding money psychology and limiting belief systems.
The 80-second principle involves developing deep understanding of the psychology of money and systematically addressing any limiting beliefs, unconscious patterns, or emotional blocks that might be sabotaging your wealth-building efforts. Many people carry unconscious beliefs and emotional patterns around money that create self-defeating behaviors and prevent them from achieving their full financial potential. These limiting beliefs might include deeply held convictions that money is inherently evil or corrupting, that wealthy people are necessarily greedy or unethical, that you personally do not deserve financial abundance, that money creates more problems than it solves, that pursuing wealth is selfish or shallow, or that financial success will somehow change you in negative ways or damage important relationships. These limiting beliefs often stem from childhood experiences, family messages about money, cultural or religious teachings, or traumatic financial experiences, but they can be identified and systematically changed through conscious effort and appropriate therapeutic work. Develop a healthy and empowering relationship with money by viewing it as a neutral tool that amplifies your existing values and priorities, rather than something that inherently changes your character. Understanding that wealth provides options and freedom to make choices aligned with your values, and recognizing that financial success allows you to help others more effectively and create positive impact in the world. Work on identifying and changing limiting beliefs through visualization exercises that help you imagine positive financial outcomes, affirmations that reinforce empowering beliefs about money and wealth, journaling exercises that help you explore your relationship with money, and working with qualified coaches, therapists, or counselors who specialize in financial psychology when deeper work is needed. Surround yourself with people who have healthy relationships with money and positive attitudes toward wealth building, avoiding those whose negativity about money might undermine your progress. Remember that changing deeply held beliefs takes time and consistent effort, but the results can be transformational in terms of your ability to create and maintain wealth.
Understanding calculated risk-taking versus reckless gambling.
The 83rd principle emphasizes the fundamental importance of learning to take calculated risks rather than avoiding all risk or taking reckless gambles that could destroy your financial future. Successful wealth building requires accepting appropriate levels of risk because completely avoiding risk virtually guarantees that inflation will erode the purchasing power of your money over time, while taking excessive or poorly calculated risks can destroy wealth very quickly. The key lies in learning to evaluate risks carefully and systematically, taking only those risks that offer reasonable potential returns relative to the possible downside, and structuring your risk-taking in ways that limit potential losses while maximizing potential gains. This sophisticated approach to risk management means conducting thorough research and due diligence before making investment or business decisions, developing backup plans and exit strategies for situations that do not work out as expected, never risking more money than you can afford to lose completely, starting with smaller positions when entering new investment areas or business ventures, and diversifying your risks across multiple opportunities rather than concentrating everything in single investments or ventures. Risk tolerance varies significantly among individuals based on factors including age, income, family responsibilities, and personal temperament. But successful wealth builders learn to gradually expand their comfort zones in appropriate ways while maintaining prudent risk management practices. Begin by taking smaller, calculated risks to build your experience and confidence, learning from both successful and unsuccessful outcomes, and gradually increasing your risk-taking as your knowledge and resources grow. Understand that the biggest risk for most people is not taking enough appropriate risks rather than taking too many, because inflation and missed opportunities represent significant long-term threats to financial security. Work with qualified financial advisors and other professionals to help evaluate major risk decisions, but ultimately develop your own ability to assess and manage risk effectively.
Understanding delayed gratification and long-term sacrifice.
The 84th principle involves systematically developing the psychological discipline to delay immediate gratification in favor of making short-term sacrifices that create substantial long-term financial gains. Wealthy individuals understand at a fundamental level that building substantial wealth requires consistently saying no to immediate pleasures, conveniences, and consumption in order to invest resources in future opportunities that will generate much greater returns over time. This might mean choosing to drive an older, reliable car for several additional years to save money for real estate investments, living in a smaller or less expensive home to reduce housing costs and free up money for wealth-building activities, working longer hours during the early years of building a business rather than maintaining a comfortable work-life balance, choosing to cook meals at home rather than dining out frequently to reduce expenses, or selecting less expensive entertainment and vacation options to maintain higher savings rates. The psychological ability to delay gratification consistently is one of the strongest predictors of long-term financial success, separating those who build lasting wealth from those who remain trapped in cycles of immediate consumption and paycheck-to-paycheck living. This skill can be developed systematically by starting with small acts of delayed gratification, such as waiting 24 hours before making any non-essential purchases over a certain amount. Choosing to invest unexpected windfalls rather than spending them immediately on consumption, or setting up automatic transfers that move money into investment accounts before you have a chance to spend it on other things. Build this psychological muscle gradually by celebrating small victories and focusing on the long-term benefits of your sacrifices rather than dwelling on what you are giving up in the short term. Visualize regularly how your current sacrifices will contribute to your long-term financial goals and the freedom they will ultimately provide. Remember that delayed gratification becomes easier with practice and that the compound benefits of early sacrifices grow dramatically over time, making the temporary discomfort worthwhile many times over. Understanding continuous education and lifelong learning. The 85th principle focuses on the critical importance of committing to continuous education and lifelong learning, staying current with trends and developments in your industry while continuously expanding your knowledge of wealth-building strategies and opportunities. The modern economy changes rapidly due to technological advancement, globalization, and evolving consumer preferences, meaning that strategies and knowledge that were effective in the past may become less relevant or even counterproductive over time. Successful people invest consistently and systematically in expanding their knowledge and skills through reading books and industry publications, taking courses and attending seminars, working with mentors and coaches, participating in professional organizations and networking groups, and seeking out learning opportunities that challenge their existing assumptions and expand their capabilities. This investment in continuous learning pays substantial dividends throughout your career and business ventures by helping you identify emerging opportunities before they become obvious to everyone else. Avoid costly mistakes that less informed people make regularly. Adapt your strategies to changing conditions and maintain your competitive advantage in increasingly complex markets. Set aside dedicated time each week for learning something new related to your field or to wealth-building strategies in general, treating this educational time as seriously as any other important business activity. Focus your learning efforts on areas that directly impact your ability to generate income and build wealth, while also maintaining broader knowledge that helps you understand how different aspects of the economy and business world interconnect. Seek out diverse perspectives and information sources to avoid echo chambers that might limit your thinking, and actively look for ways to apply new knowledge to your current projects and goals. Track which types of learning provide the most practical value for your situation and adjust your educational focus accordingly, while maintaining a balance between depth in your area of expertise and breadth of general knowledge.
Understanding professional network building and maintenance.
The 86th principle emphasizes the absolutely critical importance of systematically building and carefully maintaining strong professional relationships and personal networks that can provide access to opportunities, valuable advice, strategic partnerships, and referrals throughout your career. Your network truly represents your net worth in many situations, as strong relationships often lead to job opportunities that are never advertised publicly, business partnerships that create mutual value, investment opportunities that are only available to trusted insiders, valuable advice that helps you avoid costly mistakes, and referrals that can dramatically grow your business or advance your career. Focus on building genuine, mutually beneficial relationships rather than simply trying to use people for your immediate benefit, understanding that the most valuable professional relationships develop over many years through consistent interaction, mutual support, and shared experiences. Provide value to others in your network whenever possible by making introductions, sharing relevant information and opportunities, offering your expertise and assistance, and celebrating their successes publicly. Stay in regular contact with important relationships through systematic follow-up, social media interaction, attendance at industry events, and personal meetings when possible. Make strategic efforts to connect with successful people in your field and related areas by attending industry conferences and networking events, joining professional organizations and business groups, participating in online communities and forums, and seeking out opportunities to collaborate on projects or initiatives. Remember that relationship building is a long-term investment that requires patience and consistent effort, but the benefits often last for decades and can be worth millions of dollars over the course of your career. Be genuinely interested in other people's goals and challenges, offer help before asking for favors, and maintain your reputation for reliability and integrity in all professional interactions.
Understanding geographic positioning and location strategy.
The 87th principle involves developing comprehensive understanding of how location and geographic positioning can dramatically impact your wealth-building potential, recognizing that where you choose to live and work represents one of the most important strategic decisions you can make for your financial future. Different locations offer vastly different opportunities in terms of employment prospects and salary levels, tax structures and regulatory environments, costs of living and housing expenses, access to professional networks and industry clusters, entrepreneurial ecosystems and startup communities, and overall quality of life factors that affect your ability to focus on wealth-building activities. While you certainly do not need to live in an expensive major city to build substantial wealth, being strategic and intentional about your location choices can accelerate your financial progress significantly and open doors to opportunities that might not be available elsewhere. This might mean relocating to an area with significantly better job opportunities and higher salaries in your specific field, moving to a state or country with more favorable tax treatment for your type of income or investments, choosing locations with affordable real estate markets that offer good investment potential, or positioning yourself in areas with strong entrepreneurial communities and access to funding for business ventures. Consider multiple factors simultaneously when making location decisions, including the relationship between potential income increases and cost of living changes, tax implications at both state and local levels, availability of professional networks and mentorship opportunities, access to customers and markets for your business activities, quality of infrastructure and business services, and personal factors like family considerations and lifestyle preferences. Sometimes a strategic geographic move can double your income while actually reducing your living expenses, creating a powerful acceleration in your wealth-building timeline. Research potential locations thoroughly by visiting during different seasons, networking with professionals in your field who live there, analyzing detailed cost of living data, and understanding local business cultures and opportunities before making major relocation decisions. Remember that in today's increasingly connected world, you may also be able to leverage geographic arbitrage by earning income from high-paying markets while living in lower-cost areas, especially if your work can be done remotely or if you can structure your business activities to take advantage of these geographical differences. Understanding time management and productivity systems. The 88th principle centers on developing sophisticated time management and productivity systems that allow you to accomplish significantly more valuable work in less time, recognizing that time represents the one truly irreplaceable resource in wealth-building activities. Successful people develop systematic approaches to managing their time efficiently, focusing their energy and attention on high-value activities that directly contribute to wealth building while eliminating, automating, or delegating lower-value tasks that consume time without producing proportional results. This requires developing clear systems for prioritization based on impact and importance rather than urgency or ease, using techniques like time blocking to dedicate specific periods to your most important activities. Batching similar activities together to reduce transition time and mental energy, and regularly reviewing and optimizing how you allocate your time across different activities and commitments. Implement sophisticated productivity systems by tracking how you actually spend your time for at least one full week to identify patterns and opportunities for improvement, using digital tools and apps that help you manage tasks and projects more efficiently, creating templates and standard procedures for repetitive activities, and establishing boundaries that protect your most productive hours from interruptions and low-value activities. Learn to say no to commitments and opportunities that do not align with your highest priorities, even when they seem interesting or beneficial in isolation, understanding that every yes to one activity represents an implicit no to potentially more valuable alternatives. Delegate or outsource activities that others can do more efficiently or that do not require your specific skills and expertise, freeing up your time for activities that only you can do or that represent your highest value contributions. Regularly audit and optimize your systems and processes, looking for small improvements that can save significant time when compounded over weeks and months. Remember that small improvements in productivity compound dramatically over time, allowing you to accomplish substantially more without working longer hours, creating more time for strategic thinking, relationship building, and personal development that contribute to long-term wealth-building success. Understanding personal and business branding power. The 89th principle involves systematically understanding and leveraging the substantial power of branding, both personal and business. Recognizing that strong brands command premium prices, create customer loyalty, and build valuable business assets that can be sold or leveraged for additional income streams. Your personal brand represents your professional reputation and how others perceive your expertise, reliability, and unique value proposition in the marketplace. Develop your personal brand strategically by consistently delivering exceptional work that exceeds expectations, sharing valuable knowledge and insights through content creation and speaking opportunities, building a positive and memorable professional image through all your interactions, and positioning yourself as a recognized expert in your field or area of specialization. Business brands require careful development of clear messaging that communicates unique value propositions, consistent visual identity that creates recognition and trust, exceptional customer experience that generates positive word-of-mouth marketing, and systematic cultivation of brand reputation through all customer touchpoints and marketing activities. Strong brands reduce marketing costs significantly by creating customer referrals and repeat business, increase customer retention by building emotional connections that go beyond simple price comparisons, allow for premium pricing because customers perceive additional value in branded products and services, and create valuable, intangible assets that can be licensed, franchised, or sold for substantial returns. Invest time and financial resources in developing your brands strategically, rather than leaving brand development to chance or assuming that good products and services automatically create strong brands. This investment might include professional design work for visual identity elements, content creation that demonstrates expertise and builds trust, systematic customer experience design that creates positive associations, and consistent brand messaging across all communication channels and customer touchpoints. Monitor your brand reputation regularly through online reviews, customer feedback, and social media mentions, addressing any issues quickly and professionally to maintain positive brand associations. Remember that building strong brands takes time and consistent effort, but the long-term benefits in terms of pricing power, customer loyalty, and business value creation make this investment extremely worthwhile for serious wealth-building efforts. Understanding market cycles and economic timing strategies. The 90th principle focuses on the fundamental importance of understanding market cycles and economic patterns, learning to time your major financial decisions to take advantage of predictable cycles in markets for stocks, real estate, businesses, commodities, and other asset classes. Markets for virtually all assets go through relatively predictable cycles of expansion and contraction, boom and bust, optimism and pessimism, with each phase creating different opportunities and risks for wealth-building activities. While timing markets perfectly is impossible, and attempting to do so can lead to costly mistakes, developing a solid understanding of these cyclical patterns can help you make significantly better decisions about when to buy assets, when to sell or take profits, when to expand business activities, when to be more conservative with risk-taking, and when to position yourself for the next phase of the cycle. Generally speaking, the best opportunities for building long-term wealth arise during difficult economic times when other people are selling assets due to fear or financial pressure, while the worst financial decisions often happen during boom times when everyone is buying and prices are inflated by excessive optimism. Develop the psychological discipline and financial resources to act counter-cyclically, buying quality assets when others are fearful and selling when others are greedy and driving prices to unsustainable levels. This requires maintaining adequate cash reserves during good times so you can take advantage of opportunities during downturns, avoiding the temptation to chase rapidly rising prices during boom periods, and developing the emotional discipline to make decisions based on long-term value rather than short-term market sentiment. Study historical market cycles in areas relevant to your wealth-building activities, understanding the typical duration and characteristics of different phases while recognizing that each cycle has unique features that prevent perfect prediction. Position yourself to benefit from cycles by maintaining diversified investments that perform well in different economic environments. Keeping some resources in conservative investments that provide stability during volatile periods, and developing skills and business models that can thrive in both boom and bust conditions. Remember that economic cycles are inevitable and that those who understand and prepare for them systematically tend to build wealth much more effectively than those who ignore cyclical patterns or assume that current conditions will continue indefinitely. As we approach the conclusion of this comprehensive exploration of wealth-building principles and strategies, it is important to emphasize that building wealth is ultimately about creating options and opportunities for yourself and others. Wealth provides security during difficult times, resources to pursue meaningful goals, and the ability to help others and contribute to causes you care about. The principles we have discussed provide a framework for thinking about wealth building, but they must be applied thoughtfully and adapted to your individual circumstances, goals, and values. There is no single path to wealth, and what works for one person may not work for another. The most important step is to begin taking action, even if you start with small amounts or simple strategies. Compound interest and other wealth-building forces reward consistency over perfection, and starting early with modest amounts often produces better results than waiting until you can invest larger amounts. Remember that building wealth is a long-term process that requires patience, discipline, and continuous learning. There will be setbacks and disappointments along the way, but these are normal parts of the journey. The people who ultimately achieve significant wealth are those who persist through challenges and continue working toward their goals. Stay focused on what you can control, which includes your savings rate, investment choices, learning efforts, and work ethic. Do not spend too much energy worrying about factors beyond your control, like short-term market movements, economic conditions, or political developments. Maintain balance in your approach to wealth building. While building wealth is important, it should not come at the expense of your health, relationships, or personal fulfillment. True wealth includes financial assets, but it also includes physical and mental health, strong relationships, and the ability to contribute positively to your community. Continue learning throughout your wealth-building journey. The economic environment, technology, and opportunities are constantly evolving, and staying informed about new developments can help you identify opportunities and avoid potential problems. Be generous with your knowledge and success. Share what you learn with others who are beginning their wealth-building journeys, and consider how you can use your growing wealth to make positive impacts on others. Building wealth is often more rewarding when it allows you to help others succeed as well. Finally, remember that wealth building is not just about accumulating assets during your lifetime, but also about creating lasting positive impacts that extend beyond your own life. This might involve leaving financial assets to family members or charitable causes, but it can also involve the knowledge you share, the problems you solve, the businesses you build, and the positive examples you set for others. The journey to financial prosperity is unique for each individual, but the fundamental principles remain constant. Focus on creating value for others. Invest in your own knowledge and capabilities. Make consistent decisions over long periods, and maintain the patience and discipline necessary for compound interest to work its magic. As you rest and reflect on these concepts, allow them to settle naturally into your consciousness. Wealth building is as much about developing the right mindset and habits as it is about specific strategies and techniques. Trust in your ability to learn, grow, and create the financial future you desire through consistent effort applied over time. The path to wealth is available to anyone willing to learn the principles, develop the necessary skills, and apply them consistently over time. Your journey begins with the decision to take control of your financial future and continues with each positive step you take toward your goals.